Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacroix in London with Tom McKenzie.
And here are your top stories. Meta's mega miss. Facebook's parent plunges as user growth stalls for the first time ever. Spotify also tumbles after spotty results. Policy split. The BOE is set to leave the ECB in the dust by lifting rates and signalling more to come. We are live in London and Frankfurt. Shell's surge, the oil major boosts its buyback as profit soars on higher crude and gas prices. We will speak to CEO Ben van Beurden in a few minutes' time.
I'm looking forward to that conversation, Tom. And of course, futures are pointing to a little bit of a hesitant start. I have to say, when you look at what we heard from a lot of the tech companies in the US, look, the poorly received earnings report means that if you're a dip buyer or if you want to buy the dip, it's just a lot more difficult to see what the bottom is. For the moment, we're seeing a bit of pressure, certainly in the DAX, down some 0.3%, but actually FTSE seems to be unchanged at the open.
Just re-emphasizing, as you say, that volatility is here to stay. It makes that picture that much more complicated. The optimism of Alphabet to the malaise of Meta. And for the first time, as we said in the headlines, but it's worth reiterating, for the first time on record, the Facebook owner not adding additional users. All sorts of challenges around the competitive space with the Chinese competitor TikTok, Apple's changes. We'll get into the details of that. It's a significant story for Meta, but for the broader tech space as well. In terms of the pressure that's being felt then across the equity space in Europe, as we head to those important central bank meetings and decisions, the Spanish IBEX is down 0.5%. Don't forget that inflation came in above expectations across the Eurozone yesterday to a new record, posing a fresh challenge for Christine Lagarde and co. The FTSE 100 is gaining just 0.1%. We'll see how that's reflecting in terms of basic resources and the oil price. The CAC 40 is effectively trade-bound, range-bound, I should say. Let's switch it on and see how things are playing out then across these assets as we look ahead to the US Open and the focus still on the tech space because of the reasons we've outlined. The futures NASDAQ 100 pointing to further losses of 1.6%. I should say that broadly, of course, the market stateside ended in the green, but then we had the digestion of the results from the likes of Spotify and Meta. The euro dollar, of course, in focus, given what we're seeing from the ECB. 112 is what you're looking at in terms of euro dollar, and that pairing down just 0.1%. Again, the divergence that is expected to be crystallized later today between those two central banks, the ECB and the BOE. Though, will that inflation print move things forward when it comes to Christine Lagarde? The German two-year yield, this has been focused as well. 7 straight sessions now where the yield has edged up. So where are we going to end up on the back of this two-year yield? How much of a concern are rising yields across the Eurozone for the central bank? And the euro pound as well, euro sterling. Are we going to get back to those pre-Brexit levels for sterling? Currently, you're looking range-bound for that currency pair, Fran. But of course, it is the central banks and it is earnings that we're digesting here.
It is, and you're 100% right. It's all about divergence. And actually, our question of the day, Tom, is how will traders play the divergence between the ECB and the Bank of England? And that's also playing out in currencies. For example, the strong regional inflation print that we saw yesterday in the Eurozone is really now buttressing the euro and adding pressure possibly on the ECB to sound a lot more hawkish. Now, this is what the sectors are doing. Technology, of course, on the downside. This is not a surprise after we had that earnings report from Meta, formerly known as Facebook. Energy leading the gains, 0.8% higher. Materials, the other only sector that actually seeing a bit of gains, but getting some 0.1%. And as I was saying, it's really quite a lot of pressure on technology, leading the losses down 0.6%. Healthcare also down 0.6%. I'm really really looking forward to our interview with Healthineers, Siemens Healthineers, a huge company actually that was listed on the DAX. Can't get my words out. I'm so excited about central banks, Tom, on the DAX in September last year.
There is a lot to unpack. Siemens Healthineers, by the way, Fran, is currently down, or up, I should say, 0.5%. They posted some pretty decent results, and as Francine was saying, we're going to be speaking to the CFO later in the show. We'll unpack that in terms of logistics and input costs. But currently, they do see increased demand as a result of testing for Omicron, and that's going to lift the results, they think, for the full year. So that is one to focus on. We're back with the CFO towards the end of the show. Infineon, the semiconductor maker, currently down almost 4%. That's despite the fact they've come out with earnings that beat and said that they expect to see continued demand for semiconductors. Shell, and again, this is the most important interview, arguably, of the hour. We're going to be speaking to the CEO just in the next few minutes. Gaining 1.3%. Net share buyback after a very strong set of results increased to above $8 billion for the first half. Of course, those higher energy costs, higher oil prices are a major factor for that. How are they going to put additional cash to play? Well, that's a question we're going to put to the CEO. So that's a rundown of some of the big corporate names, but it's been a very busy day for earnings, Francine. This is just a pick of the many that have come through this morning.
Yeah, I'm really looking forward to our conversation, Tom, with the Shell Chief Executive, Ben van Boyden, in just a few minutes from now. Of course, we'll ask him about earnings, as well as the outlook for the green transition, but we'll also talk finance and hard dividends. If you look at the cash flow, and thank you, Valerie, for putting this chart up, and this really encapsulates some of the concerns that investors, also activist investors, have for some of these companies. If you look at cash flows, I think we can bring this great chart, the chart of the hour, actually, for me, away from central banks, and you can see the difference in how they've been, performing in terms of free cash flow compared to Total, rebranded Total Energy to see more green in France, and BP. And of course, a benchmark linchpin of all of this is Exxon. We heard from them just yesterday increasing the pace of their $10 billion buyback. And we'll see how that filters and puts extra pressure on some of these European companies, Tom.
Yeah, and a key question that we're putting to the CEO is, as you make that important transition to the renewable sector and you start to invest there in terms of CapEx, does that necessarily mean that free cash flow starts to reduce? I think they put in about 8 billion additional free cash flow in the latest quarter, so we'll unpack that with the CEO. Okay, let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. Spotify shares sank in late trading after falling short on its forecasts for monthly active users and paid subscribers in the first quarter. The company did not provide a reason for the shortfall or whether a recent artist boycott is impacting the business. The streaming service did beat full-year estimates for 2021, though, with India, Indonesia and Latin America driving growth in the most recent quarter. Qualcomm shares slipped in late trading after efforts to expand beyond its main business were hampered by chip shortages in the latest quarter. The biggest maker of semiconductors for smartphones reported sales and profits that easily topped analyst estimates. But the company fell short of projections in certain categories, including chips for cars. A new super yacht for Jeff Bezos is so large that a Dutch bridge is being dismantled so it can be delivered. The Amazon founder's new 417-foot ship is being built in the Netherlands and needs to pass through Rotterdam to get onto the sea. One Dutch politician says dismantling the crossing is really going a bridge too far. Tom, Francine, you know what they say about yacht owners. The best day of your life is the day you buy and the day you sell.
Thanks to Laura Wright. I, unfortunately, will never own a yacht. Actually, I don't even know if I want to.
I thought you had your order in with the Dutch. I thought they were building that. I don't know how to move.
I mean, if I buy anything, it has to be Italian.
Well, this is true. I mean, the furnishings and the fittings have to be top-notch, right?
Yeah, from Venice. Now, turbulent day for the markets. We have policy decisions from the BOE and the ECB coming up. Also closely watching, of course, big tech after a major miss from Meta, formerly known as Facebook. We have all of the angles covered. Our markets editor, Christina Kino, standing by in London. Our UK economy reporter, Lizzie Burden, is at the Bank of England. And then later, we'll also go to Manus Krani at the ECB in Frankfurt. Christine, for stock pickers, good morning, first of all. For stock pickers, I mean, this is a bit of a nightmare because some were expecting Facebook to not do great, but the shares actually were down 22%.
Absolutely, Francine, and that really will be historic. If that holds through the Thursday session, that would equate to a loss in market value of more than $200 billion. That would be the biggest loss for any company in one day. And so it's very, very historic. And we're definitely feeling the effects of that. It was particularly pertinent in Asia. A lot of those markets are just coming back from the Lunar New Year holidays. And it was quite the shock waking up to such a massive loss and decline for Meta here. And it really is, again, we were talking about the asymmetric risks that we're witnessing in these earnings season, particularly for these tech sectors. And again, Meta is a great example of that. A big loss will be met with a lot of punishment from investors. That's exactly what we're seeing. And of course, we're seeing that flow through across different asset classes, primarily the crypto complex, which has become a more correlated asset to the tech sector in particular.
Interesting. So watching the ripple effects of those Meta earnings, and just a reminder as well of just how much it's going to cost to build out the metaverse, with more than 10 billion spent by that company last year. Let's go then from the corporate to the macro and the BOE. Of course, a major decision for the Central Bank of the UK later today. Lizzie Burden standing outside the BOE today. It seems like a hike to 50 basis points is baked in at this point, Lizzie. So take us through what to expect and bring us forward to the decision making about the balance sheet as well, the challenges for Andrew Bailey and co.
Yes, Tom, I'm outside the Bank of England, and policymakers in there have been eerily quiet since the December decision, when they, of course, had that first pandemic hike. So we can only assume that they don't want to correct the expectation of markets and economists that they're going to hike to 0.5% today, the first back-to-back increase since 2004. So we'll be looking ahead to how fast and how far the bank's going to tighten this year. Bloomberg Economics expects rates to end the year at 0.75%, but markets think they'll be 1% by June, and that's the level where officials have said they'll start active quantitative tightening. We might get an update on that today, but the clues will come in the inflation forecast and in the remarks from the governor. If he emphasises the cost of living crisis, that could signal that policymakers are worried about the hit to consumers of tightening too steeply too soon. But if he emphasises the risk of a price wage spiral, that could show that we can expect faster tightening sooner.
Lizzie, thank you so much. Of course, what markets want to know is, are they going to be as hawkish in terms of their messaging as the Fed? Let's also get to Frankfurt, where, of course, the ECB is meeting, and our Manus Cranny is on the ground. Manus, we had a pretty blowout inflation print yesterday from the Eurozone. Is it going to be much harder for Christine Lagarde to sound as dovish as she has in the past?
I think, you know her, you sat down with her much more often than I think she's going to be quite steely and unrelenting in her view that inflation is elevated but not enduring. I think ING wrote a cracking note where they said she has to communicate patience rather than panic. And I think the underbelly is where is long-term inflation expectations. That is rolling over. That's coming down. Yes, you have a backdrop of the highest inflation ever, driven by energy prices, but the core of inflation is coming down. The break-evens are rolling over. And so I think she'll play to that side of the macroeconomic equation. But there's a tussle, Francine, between the market and the ECB. The ECB says no rate hikes until 2023, but the market is baying for a hike. They're pricing in 25 basis points by the end of the year, and even as near term as July rather than September at one juncture yesterday.
Yeah, who wins this battle, and to what extent will the hawks amongst the ECB be pushing as well, Christine Lagarde, to act faster? Great stuff, Manus, on the ground, of course, outside the European Central Bank, the whole team as well, bringing to the fore the key themes that are shaping the equity markets, these asset markets, of course, assets across the space here. Thank you, Manus Cranny, Lizzie Burden, of course, outside the BO, and Christine Aquino here in the studio. Francine.
Now, a full, of course, earnings outlook. Coming up, Shell comfortably beats fourth quarter estimates on the back of soaring energy prices, and we speak with the chief executive, Ben van Boorden. One of our main questions is, how can he maintain these returns when CapEx is still low? We'll see you shortly. This is Bloomberg.
U.S. has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
Welcome back to The Open, everyone. 14 minutes into the European trading day, and you can see a bit of pressure on the European stock 600, mainly technology stocks, on the back of what we heard from Meta, formerly known as Facebook. And it's very clear that now, for stock pickers, or certainly from some of the dip buyers, the situation is a little bit more complicated. We also have central banks, so let's focus the minds. Tom, two questions we need to know. First of all, does the inflation print we had yesterday from the ECB mean that Christine Lagarde cannot be as dovish as she was? And the contrary, flip question for the Bank of England, are we going to hear Governor Bailey be almost as hawkish as the Fed, given the inflation forecast that will be adjusted?
Yeah, and we can't talk about inflation, of course, without talking about energy prices. That was a key component, up 28% within that Eurozone CPI. And so from that story to what's happening at the corporate level around energy, oil, of course, Shell has expanded its first half-share buyback program to $8.5 billion. That is after the energy giant reported profit that blew past analyst estimates on the back of surging energy prices. Joining us now is Ben van Beurden, CEO of Shell. Good morning. Thank you for joining us. Where do these results leave you as you look ahead to 2022? Do you expect to see continued benefits from sustained higher energy prices?
Yeah, thanks for having me, Tom and Francine. It's good to be here. Well, I think if I look at 2022, I think we start the year with a lot of confidence on the back of what was, after all, a tough year, 21, but also a year where we made a tremendous amount of progress. Our portfolio performed so much better than it did before the pandemic. And indeed, with debt having been reduced by $23 billion in a single year, generating this year as much as $40 billion of free cash flow, a very modest step up anticipated in capital, we will have a lot of free cash flow to play with to continue to return to investors, which I think is going to be the priority for 2022.
And Mr. van Beurden, we have a great chart actually looking at cash flow and how Shell compares with some of their competitors. But how can you stick to these returns given the backdrop that we're seeing? It's higher inflation, CapEx still low, and oil production is falling.
Yeah, so if you look at our cash flows for 2021, we did about $55 billion if you exclude working capital effects, which are, of course, transient. So 55 is the underlying number. That is at an elevated oil price, of course. But the macro, even though it's much stronger than at the beginning of the year, I think is not too incomparable to what we have seen before the pandemic. And you have to bear in mind, chemicals margins haven't been great yet. The refining margins have also been quite moderate. So much of the strength you are seeing is also just portfolio strength. It's not just the macro playing up. And indeed, we believe that with much lower break-even prices in our projects, we can sustain this portfolio at lower capital levels than we were talking about before the pandemic. So when we say stepping up our capital to $23 to $27 billion, we probably will be at the bottom end of that range. And I believe that this is going to be a stable and long-range position for us to be in. So, as I said, I look with a lot of confidence to the year ahead.
Okay, and obviously you're trying to build out the renewables part of the business, and investing in that is crucial for Shell and the rest of the sector, and you've talked about that. But is it necessary? Is it an expectation of investors that as you invest in renewables, that free cash flow is necessarily going to come down?
No, I don't think necessarily that is the case. Now, of course, we have a very small renewables business at this point in time compared to the rest of the business. So we will be going through a period of building up that business. So don't expect a lot of free cash flow contribution from, say, for instance, our power business, our hydrogen business, our biofuel business, because most of the cash, if not more than the cash that we produce, we will also be reinvesting and actually building that business. But it's not just investment, Tom, I would say. A lot of people look at the capex we spend on this, but we spend actually more OPEX than capex on these new business models. Altogether, we spend about $55 billion a year, and of that, about a third we invest in the energy transition. And we want to step that up to roughly half by the middle of this decade. And I think in the long run, what you will find that the returns that we aim to get out of this business are very competitive returns that actually, certainly if you risk adjust them, very favorably compared with the rest.
Mr. Van Beurden, I mean, you have been criticizing this, in the past because you spent too little on renewables. When are you expecting capex for renewables to actually outgrow the rest of the business?
Well, we have been spending about $2 to $3 billion on renewables. But then again, you have to bear in mind, Francine, if you look at the energy transition, it's not just what we put into wind parks. It's also what we put into biofuels, also put into hydrogen. It's also what we put into electric charging. And if you just look at the operating costs, which we spend on these aspects of our business, it is actually altogether about a third. Now, if you then look at when do we do more than half, I would say by 2025. By 2025, we want to be evenly balanced and spend at least 50% of our total resources on the energy transition.
Okay, you talked about the challenges of 2021, and one of them clearly was the activist investor Dan Loeb and Third Point. What have you been talking to that team about? How have you been trying to convince them of their case? They, of course, want to see a split up of the business, a division of the business. What are your conversations like at this point with Third Point and Dan Loeb?
Well, I think congratulations would be in order. I think Dan Loeb has been a smart investor. He stepped into our stock at the right moment, and I'm sure he is enjoying the returns that we will have seen so far. But on top of that, we talk to all our investors, including Third Point. There's always new ideas that we pick up, and we incorporate these ideas in the evolving strategy that we have. I think at this point in time, also the strength of the integrated model is very much in evidence. But at the same time, we also realize that we need to accelerate the pivot out of our traditional business into the business of the future. And there are many ideas out there from investors on what we need to do.
Have any other major shareholders also asked you to split up?
No, I think at this point in time, I think there is always a range of views out there, but I can't say that we are faced with a sort of a broad call from shareholders on that matter. There are different views from different shareholders all the time, Francine, and our task is to incorporate these ideas into a coherent strategy, and that is, I believe, what we have been doing also over the last year.
Okay, can we get your views on the geopolitical story at the moment, Russia, Ukraine? If there is an invasion, we're not there yet, but if there is one, would you expect a sharp spike in gas prices? How would the industry navigate that? And are your JVs in Russia exposed to sanctions?
Well, Tom, I think it is indeed a very important story at the moment. And to be perfectly honest, we are watching it with as much interest as everybody else. We have no special insight in it, of course. We have some special interests that you refer to that are sort of contributing to our curiosity and preparedness for it all. Let me offer a few observations, though, is that, first of all, if you look at the supplies from Russia, under many difficult geopolitical conditions, these have never been disrupted. So that's, I think, one point to bear in mind. The other point to bear in mind is that if they are going to be disrupted this time around, I think it is more likely they will be disrupted by way of sanctions rather than by way of unilateral action. We have to be ready for that, of course, also in terms of what it means for energy provision to Europe. And we are. We make sure that our facilities in Europe run very well. And if need be, we will be, of course, also supplying more liquefied natural gas in Europe, as we have been doing over the last winter. What it would mean for our operations in Russia, I think, would be speculative. So I would just like to refrain from commenting on this at this point in time.
Talk to us a little bit about your trading units. Did oil actually register a loss, and how did gas trading do?
I think trading is always, of course, a range of different outcomes. It's fair to say that oil trading didn't have its strongest quarter in Q4. That is often the case, of course. What we have seen is extraordinary volatility in the gas markets. Actually, volatility beyond what we think is useful and helpful also from a trading perspective. But with that, of course, we have been able to position the business as much as possible to take here and there opportunities that have been offered. So yes, our gas trading business internationally has been doing well.
All right, thank you so much, Mr. Van Boorden there, Ben Van Boorden, the Chief Executive of Shell. We'll have plenty more, of course, on some of these earnings results. We'll also talk central banks. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Welcome back to the Open. We are 26 minutes into your European trading day. European stocks currently lower by 0.3%. Future stateside pointing to losses. Stay with us. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. Meta's mega miss, Facebook's parent, plunges as user growth stalls for the first time ever. Spotify also tumbles after spotty results. Policy split, the BOE is set to leave the ECB in the dust by lifting rates and signaling more to come. More on today's key central bank policy decisions this hour. Plus, Siemens Healthineers raises full-year guidance as demand for COVID test kits boosts profits. We'll speak to the Chief Financial Officer, Jochen Schmitz, in just a few minutes. So, Tom, it's all about central banks, but of course there's also a dampener because of technology stocks, and that's filtering through to the broader markets. On central banks, it's really a tale of divergence between ECB and BOE.
It is indeed, and whether or not the ECB will forced and be compelled to act earlier than they have hoped to up until this point, at least, given that CPI number. Another record print for the Eurozone yesterday. That was a surprise. And so to what extent does that fuel the debate amongst the hawks versus the doves in the ECB? Manus Skrani is on the ground in Frankfurt. He's going to be keeping us up to date on that. That decision, of course, later today, along with the Bank of England, which is expected to post its first back-to-back rate hikes since 2004. The European markets then looking at the murkiness of these earnings on the back of what happened with Meta and weighing that up against the monetary policy picture as well, where investors are seeking clarity. Currently down 0.3%. The DAX is down 37 points. Your range bound on the CAC 40 and the FTSE 100 up 0.1%, supported by basic resources. We'll see that flow now as we cross over to the sectors picture, and it is basic resources, the last time I looked at least, that was leading the pack. Let's have a look and see how things are breaking down sector by sector. There we go. Basic resources gaining 0.3%, number 2 now under consumer. Autos and parts also in the green. So just 5 sectors. They're just posting modest gains currently. At the bottom of the list, you've got industrial goods and technology, also retail. Technology, of course, the read across from Meta. That very disappointing set of results. Real surprise there. The first time on record that company has not managed to grow its user base. But let's get back to the central banks and monetary policy. We talked about the BOE. Andrew Bailey's going to be taking that stand, making that decision at 12 o'clock later today. But Christine Lagarde as well, really facing a challenge now on the back of that CPI. And that's been reflected in terms of the bond markets. You've seen the German 2-year yield, 7 straight sessions where the yield has edged higher. Again, as markets and investors start to bet. Money markets betting that you're going to see 10 basis points a hike as soon as July. But a reminder, Christine Lagarde has consistently come out and says it is unlikely we're going to get a hike in 2022. So that's how we're set up into that ECB decision with the BOE as well to be thought about. Fran?
I know, I love it. It's going to be a lot more interesting than we thought maybe a couple of weeks ago, as that, of course, yield curve flattens and markets are pricing in, hawkish hikes for hawkish comments from Christine Lagarde. We'll see whether she looks at that inflation print yesterday and actually just comes out as a lot less dovish. So will traders and economists look back on today as the day of divergence between between Europe's two biggest central banks. Now, the Bank of England largely expected to provide the first back-to-back rate increase since 2004, while the ECB is sticking to guidance that it will not hike this year. Yesterday's inflation shock, though, as we were saying, may provide impetus for Europe's central bank to change its guidance. Consumer prices jumping to 5.1%, the highest since the creation of the single currency. Now, traders see the Bank of England and the Fed boosting key rates 5 times each. Even with two 10 basis point hikes, the ECB is expected to remain deep in negative territory by the end of 2022. Well, joining us now for a robust discussion on central banks, Suzanne Hutchins, head of real return at Newton Investment Management, and Yari Sten, chief European economist at Goldman Sachs. Yari, let's kick it off with you. That inflation print in the Eurozone, how difficult will it be for Christine Lagarde to remain dovish after that?
Yeah, I mean, it was certainly a very big upside surprise, the biggest in history. And, it does mean that inflation will remain a lot more elevated than they thought only in December. And so we do think they will acknowledge that today and flag upside risk to the inflation outlook and say they have optionality to respond to that. But at the same time, we think they will stick to the message that inflation is likely to cool back below 2%, given subdued wage growth, and that rate hikes this year are highly unlikely. So I would say it's an incremental shift towards tightening since December, but we don't look for a policy pivot at today's meeting.
Okay, Suzanne, let's bring you in at this point. How do you trade the divergence that we're seeing amongst these central banks?
I certainly think that, the ECB is under pressure to raise rates ultimately. And the way that you would position your portfolio is that if you could, you would be short the Bund as the, yields are going up. And obviously we've seen them to be slightly positive now. So, you certainly want to have inflation type hedges in your portfolio, as we've been doing in the Newton Real Return strategy.
Suzanne, time and time again, and I want to go to the German curve, as it continues to flatten, time and time again, it seems that the markets over the last 18 months have really led the way and haven't been that wrong or far off what central banks were saying. I mean, do you trust the markets more than what central banks are telling us?
I certainly think that you should take note of the bond market. That's always a very good tell sign of what's coming next. And as we've seen in the US, rate hikes have been significantly priced in now to the extent of perhaps 7 rate hikes in the US, which actually may be a little bit much at this point. But policymakers are very much focused on keeping inflation under control, and that will be the main focus this year.
Yari, the key question a lot of people focus on when it comes to ECB decision-making around inflation, the key differentiator has been wages and the fact that you're not seeing the kind of wage pressure across the Eurozone that you're seeing in the UK and the US. Does that continue to be the case? Are you seeing any evidence? Is any of the data that you're looking at suggesting that wages are starting to become stickier in the Eurozone?
Not really. We are seeing wage growth, we think, around 2% in the euro area. We have to be, a little bit careful here because there are lots of distortions in the data. But when we clean the data, we are running at about 2%, which is actually slightly below where we were before COVID in the euro area, which we think means that we still have some spare capacity. And that is in sharp contrast to what you're seeing in the UK and in the US, where wage growth is running somewhere between 4 and 5%. So we do think wage growth will go up in the euro area, but I think it's going to be a more gradual process than in the other countries.
But Yari, what did we see yesterday with that inflation print? I mean, can we call it an inflation shock? And how were analysts so far off actually what we ended up with? What is it, energy prices? Like, what exactly, are we measuring things wrong? What's going on?
Yeah, I mean, a few things at play. I think the key was a big surprise in goods prices, big surprise in energy prices, which I think continues the theme that it's really global inflation that is pushing up European inflation. Whereas on the services side, I mean, you've also obviously seen firmer prints, but not nearly to the same extent. And so I think it's a theme where global bottlenecks, tight energy markets continue to push prices higher globally. But going back to the wage growth picture, I think that is something that is still more subdued in the euro area. And I think we need to keep that in mind when we read these prints.
Suzanne, how are you thinking about opportunities in the UK equity markets as the BOE looks to, at least the money markets pricing in this hike later today? Are there opportunities still when it comes to the value play for UK?
Oh, absolutely. What is interesting about the dynamics of the UK market is its heavy orientation towards the commodity areas and financials, and particularly financials, which are big beneficiaries of the interest rates going up and their net interest margins improving, and hopefully, bank lending increasing at the same time as well. And on top of that, as you know, there's been a real love affair with growth stocks, particularly in the US and, the NASDAQ. And there are markets outside of the US which we think look really attractive. The UK and Europe particularly being those markets.
Yari, talk to me about what you're expecting from the Bank of England. So this is, without a doubt, one of the best charts because it really sees market expectations. We haven't really heard a reminder for our viewers from that many MPC members, and that was probably deliberate after the fiasco that we had at the end of last year. But when you look at what the market is pricing in, and I wonder whether the market implied interest rate path for the MPC will also feed into their forecast. I mean, our policymakers are going to push back against this market pricing because inflation could be below 2% still this year.
We don't expect that today. We expect a clear decision to hike 9-0. We think they will indicate the start of balance sheet runoff. And then we think that there will be upward revisions to the price projections, particularly on the wage side, where we actually think that wage growth will remain above 4% for this year. And so we look for a message that the tightening will continue, and we look for 4 rate hikes this year, with the next one coming in March.
Okay, Suzanne, we started this week talking about the fact that 80% of the S&P 500 companies that reported had beaten estimates. And then we came out with Alphabet, very strong beat there. Now we've got Meta and Spotify muddying the waters. How are you looking at the earnings picture? How much transparency do you have as you look ahead to the quarters of 1, 2, and 3?
Well, I think that a lot of the companies that have reported have been perhaps not able to give very clear guidance about the future because there is still supply chain problems. But I really actually think that the direction of markets and and earnings ultimately is very much dependent upon rate policy. And I do actually think that we are in a very different and challenging environment for markets as the liquidity backdrop does tighten and obviously interest rates go up. So I think there's a real indigestion that's going on in markets at the moment, particularly as we see very, very highly valued growth stocks perhaps disappoint. And then there's other areas of the market that look very opportunistic that have been out of favour for a good period of time. So I think there's lots of opportunity in these markets. But you've got to take a long-term perspective and really focus on valuations this year.
Yari, I mean, given the difference we see with, the ECB, with Christine Lagarde again saying that actually we're probably not going to see a hike. I don't know whether that changes today. And the Bank of England solidifying its position as one of the most hawkish central banks out there. Is it a problem for each other, this divergence, because it plays out on currencies?
I mean, it will have implications for currencies. I think that's right. I mean, that's true, of course, also with the United States, where the interest rate differential is set to widen a lot this year. But at the same time, we think that solid growth in Europe is something that still pushes the other way. And so, despite the very weak data we saw around the turn of the year because of Omicron, we actually still think that the growth outlook is a pretty robust one. And that is something that should support the currency. So I think they're sort of offsetting forces here on the European currency.
Thank you both for joining us. An exciting central bank day. Suzanne Hutchins, head of real return at Newton Investment Management, and Yari Sten, chief European economist at Goldman Sachs International. Now, coming up, Siemens Healthineers raises its full-year guidance as strong demand for COVID tests kits boost profits. I know Tom McKenzie had a great idea of actually pairing them up with Philips to see who's doing better. I mean, it's amazing how their earnings really was off the charts because we're testing so much more again because of Omicron.
Yeah, will that be sustained as well as they challenge, and they face those challenges of input costs and logistics as well? Questions we will put to the CFO, Jochen Schmitz. That is next. This is Bloomberg.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
From New York City. We're in London, in Sydney,
in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
To recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Welcome back to the Open. We are 45 minutes into the European trading day. You are lower by about 0.4% across the benchmark stock 600. 0.3%. You've got a little bit of green on the screen. Here in the UK, the FTSE 100 up a tear, 0.2%. The CAC count higher as well, just by 0.1%. Across your sectors, basic resources gaining. Healthcare, by the way, is lower by about 0.7%, despite the fact you had some decent earnings coming through from Siemens Healthineers. Currently, that stock is up more than 3%, Francine.
Yeah, I'm really interested actually in this company because they've done so well because of some of the antigen testing and of course molecular, and some of their rivals haven't been doing so well. So time for our earnings news. Siemens Healthineers, that Tom was just mentioning, raising its full year guidance after demand for rapid coronavirus test kits boosted profits during the first quarter. And we are delighted to be joined by the company's chief financial officer. He's Jochen Schmitz. Mr. Schmitz, thank you for joining Bloomberg European Market Open. Now, Roche said that actually in terms of testing, it didn't pan out exactly that they were expecting. So, why the difference, and how much testing are you expecting going forward?
I mean, for Roche, testing is much more dominant than it is for us. Yeah? I mean, diagnostic is one segment. We had a very strong start across the board on our radiation therapy business, on our imaging business, on our advanced therapy business, and on top of on the diagnostic business, partially driven by antigen, but also the core routine care business is very, very strong. Yeah? And we have raised our outlook for antigen from initially 200 million revenue now to 700 million, on the back of the Omicron variant, which was not part of our outlook when we gave the outlook in November. And we also got the approval to sell the tests under the emergency approval in the United States.
Okay, so that demand is there. You expect it to be sustained, it sounds like. What about costs? We were talking about inflation. We've got the central banks coming up, the ECB, the BOA later today. How is the cost structure changing at your business? You mentioned procurement costs, particularly around the imaging part of the business. Where exactly are those costs being felt, and what are you doing to mitigate them?
Yeah, man, first of all, when we talk about supply chain topics currently, you have to differentiate between top-line impacts and cost impacts. I think what we have achieved, first of all, is that we have no impact on the top line, no material impact according to plan, based on the strong efforts of our team. On the cost side, we obviously face headwinds. It's coming from certain parts, in particular on the electronic side, but certain raw materials like metals and logistic capacity. But also coming back to the delivery opportunity we have, we also have to change sometimes between sea and air freight currently, which raises costs.
Right. So, Mr. Schmitz, in terms of the logistic costs, are there any regions where logistics seem to be more of a nightmare than elsewhere? Is it U.S. ports or elsewhere?
I think it is partially China because of their rigid, I would say, COVID regime, that they suddenly close out harbors completely for several days and things like this. But I have to say the supply chain on the logistics side is globally under tension, because I would say also of the changed behavior of consumers with regard to their buying behaviors. Therefore, logistics becomes more and more an important topic, and the capacity is not fully, I would say, built up to this.
Okay, what is the time frame you're looking at, though, for the easing of those logistical challenges? How are you planning for that? And input costs as well. Do you expect them to remain elevated throughout this year?
No, I think we have seen on the, I would say, on the part things, I think we have seen, so to say, the worst. We see that stabilizing. And we expect in our fiscal year, in the second half, to see some relaxation of the topic on the parts cost as well as on the logistics side.
Mr. Schmitz, very quickly, because we can hear you well, but it's not as clear as we'd like it to be. On semiconductors, what's your plan? Or do you have difficulty accessing those?
It's not more difficult than for others, but we have strong relationships with companies who supply us, and so far we could deliver everything we wanted to deliver.
Okay, Jochen Schmitz, Siemens Healthineers CFO. Thank you for your time this morning. The company lifting their outlook. Fran.
Now, coming up in Meta and Spotify, well, both of them plummet in late trading after disappointing results. We'll break down the numbers and what it means for tech in Europe. That's coming up shortly, and this is Bloomberg.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your just soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open. Checking in on your markets. European stock 600 are currently lower by 0.3%. US futures pointing to losses as well. 0.8% on the S&P. E-mini futures close to 2% on the Nasdaq, following that period of terrible set of results from Meta, the parent company, of course, of Facebook. We're looking ahead to the central bank decisions of the BOE and the ECB. So the euro dollar currently at 112, pound is at 135. Let's focus and continue the focus on technology shares then in Meta, parent company of Facebook, as I mentioned, and music streaming service Spotify, both plummeted in late trading after disappointing numbers. Let's get the details then with Bloomberg's Laura Wright. Laura, what were the main headwinds then for Meta?
Big headwind. We've learned the metaverse is going to be expensive, Tom. In fact, for the full year of 2021, that pivot towards virtual and augmented reality cost Facebook $10 billion. That may impact Mark Zuckerberg's ability to purchase super yachts. His personal wealth tumbled by $24 billion as a result of that ugly after-hours trading. So what was a real problem? Well, the flagship product for Meta is Facebook, and you can see a plateau in users over the last 3 quarters, 2.9 billion monthly average users. A key headwind was privacy. So these Apple privacy changes mean that Meta can no longer automatically take user data from Apple devices. And on the earnings call, the COO, Sheryl Sandberg, admitted that SMEs, that's been a big problem because they rely on targeted advertising. TikTok, a big competitor for Facebook's Reels. Yeah. That said, I was just reading a recent note from Morgan Stanley, Francine, but they are bullish that Facebook will be able to monetize Reels.
Yeah, Facebook, I mean, there are very few people, even in the newsroom, that still use Facebook, so that should have been a very telling sign. Spotify has had quite a tough week, and they actually turned things around.
Yeah, controversy for Spotify this week with podcasts, Joe Rogan. The outlook was poor in terms of subscribers, just 3 million additional subscribers estimated for the first quarter. But what was really interesting is advertising sales for Spotify. They now account for 15% of total revenue. They've been able to bring new listeners onto the platform with podcasts, monetize that. The goal for Spotify, Francine, is to have 50 million users creating podcasts in the future. So I look forward to what yourself and Tom's podcast will be about.
About markets and central banks, of course, nothing too controversial. Actually, today may be very controversial between the divergence between the Bank of England and, of course, the European Central Bank.
Yeah, look, the central bank action, of course, has been a reason why you've got so much liquidity in the markets, why there's so much wealth. This leads us on to the story, Jeff Bezos and his yacht. 127 meters, this is the plan for this boat, about $500 million, but a struggle getting it out of port.
I mean, the problems that the rich face, it is quite a story. Also, just looking at some of the wealth that some of these, big, rich technology giants have lost. I think, Mark Zuckerberg lost, what, 24 billion?
Yeah, 24 billion.
Like a couple of days. All right, it's all about central banks. We have some great divergence plays, so this is playing out on currencies. And then we look at whether Christine Lagarde becomes less dovish and whether we see the Bank of England actually pushing back against some of those hawkish expectations.
Yeah, any commentary around the balance sheet as well from the BOE will be in focus. That decision at 12 o'clock. Stay with us as we weigh up, of course, the central bank action and these earnings are becoming thick and fast. Plenty more ahead. Surveillance Early Edition. Stay with us. This is Bloomberg.
this chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
There are some aspects of this inflationary pressure that ought to be transitory.
We'll stand ready to act one way or the other.
So the two that I would ought to be transitory are one related to commodity prices, including energy prices.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance, everyone. This is Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Meta's mega miss while Facebook's parent plunges as user growth stalls for the first time ever. Nasdaq futures point to the downside. Policy split. The Bank of England is set to leave the ECB into dust by lifting rates and signaling more to come. We're live in London and Frankfurt. And stay with Bloomberg Surveillance Early Edition. This hour, we speak to the former Bank of England MPC member, Andrew Sentence. Send in your questions on IB plus TV Go. He is always, shooting from a hip and always straight talking. Now, first thing is first, let's check on the markets. And the main question for the markets, if we focus our minds, is really how do you play this divergence between the Bank of England and the ECB? Then, if you're a dip buyer, or certainly you want to come in at some of these levels, what do the disappointing tech earnings in the U.S. mean for you? European stocks down some 0.3%, really dragged lower by technology shares, down some 1.2%. And of course, what we saw from Meta yesterday, formerly known as Facebook, but also some of the Spotify earnings that really overshadowed the good news we had from AMD, is not only filtering through to Europe, but infecting some of the rest of the markets. Commodities still holding strong, but then instead of focusing on supply, one of the other things we need to hold on is demand. You can see Nasdaq futures on the way down some 1.9%. And when I have the best chart I need to show to you right at the top of the hour. We don't do this very often, but thank you, Valerie, for bringing it to my attention. And it's very clear that the market will try and push today. Andrew Bailey, again, we have the decision, we have a press conference, and then we'll try and catch a couple of minutes with him. We are seeing price in one of the most aggressive stances in terms of hawkishness from Andrew Bailey and from the Bank of England. We have not heard from MPC members that much in the last couple of weeks, so it really depends on whether he goes full-on Fed and is just as hawkish as what we heard from Jay Powell, or whether he tries to walk back some of that market expectation that we're seeing in the markets. You can see the Bloomberg forecasting some 1% by the first quarter of next year. So we'll have a full imprint of some of the central banks, and of course, you probably play it through currency divergence. Now, let's also talk about technology stocks. What are we witnessing, or have we witnessed peak Facebook? Well, that's a question, of course, at the top of investors' minds today after the social media giant's parent, Meta, reported that Facebook user growth stalled in the latest quarter. That and also a downbeat outlook saw shares plummet by almost a quarter in after-hours trade. Adding to that tech pain, Spotify announced a disappointing subscriber growth forecast for the first quarter. So let's dive into the tech story. Then we talk central banks. We're joined by our Bloomberg markets editor, Christina Kino, and Alex Webb from Bloomberg. Quick take. Alex, I mean, Facebook is seeing some serious concerns, but then we knew also that users just were not using Facebook as they were in the past. How do they recoup the losses?
The problem was that it was a hit on several different fronts. The outlook wasn't good, the user growth stagnated, the revenue and profit missed estimates. It was sort of bad across the board. That is something that investors are therefore punishing them for. Meanwhile, you see TikTok continuing to grow. So it wasn't necessarily a story of lockdowns easing and therefore people not spending as much time on social media, because they are spending it with Facebook's rivals. So what do they need to do? They've said their North Star is to try to address the younger audiences, 18 to 24-year-olds. They've also investing in the metaverse. Can they do both? Can both of those be a success? It's not really. They did very well when they pivoted to mobile almost a decade ago, but other new product efforts on the whole have not been terribly successful.
And Christine, of course, this is, filtering through the broader market, because if you're a dip buyer and you kind of wonder whether some of the corporate earnings, can pull you away from the markets being worried about central banks, you kind of think twice because of some of the tech earnings.
Absolutely, Francine. I mean, for a moment there, it was looking like it would be a nice week to buy the dip and get back into some of those tech stocks, especially after some promising earnings from Apple and Alphabet. But then we got this shock from Facebook and Meta overnight, and that really just destroys this notion of there is room to buy the dip here, because again, this asymmetric risk that we're seeing during the earnings season, there is outsized punishment awaiting any company, particularly any company in the tech sector that really misses on its estimates, and Meta here just missing massively, just getting the brunt of that pain from markets this morning.
Alex, when you look at how much Meta spends, you reminded everyone, 10 billion on the metaverse last year. Could this actually be a genius play? Like, what kind of timeline do we find out whether this was the right thing to do?
Well, there was some interesting comments from Mark Zuckerberg, because he was saying that the metaverse doesn't require 3D headsets, doesn't require Oculus Rift. That seems also to be a tacit admission that we're some way away from those 3D headsets, virtual reality headsets, reaching scale. And it is kind of true. Like, I'm coming to you over Zoom. In a sense, that is the metaverse, right? But it isn't really the vision that everybody has. And is it enough at this stage to get people accessing Facebook through its own devices? And that's what Facebook really needs. It wants to circumvent Apple, because Apple is hurting them on the advertising front. So that's the real challenge. And it does seem as though it's perhaps some way away.
Yeah, and Christine, one of the things that actually I'm seeing more and more notes on from big banks is this just a further derating? That if you look at Facebook at face value, it was not great, but it wasn't that bad. But then it also sent a snap down some 10%. If you look at, for example, Qualcomm, they saw weakness despite some very good set of numbers. So is it run for the hills?
It certainly has that feeling as far as today is concerned, Francine. And yeah, I think this really goes to the fundamental question again of what would these companies, especially these high growth tech sector companies, really have going for them in terms of fundamentals? And will that be enough to help them withstand a broader macro environment that's really turning a little bit more negative for this sector in particular? And so I think, the earnings season this time around, it really is a bit of a soul searching for investors, really digging into those individual company fundamentals and scouring through the lines of various data and trying to figure out, will these companies have enough going for them independently that they'll be able to withstand this new era of tighter monetary policy and higher yields that we're facing?
So if we boil it down to one question, Alex, is the real question we need to answer, is it too late for Meta to take on, the juggernaut that is TikTok?
Absolutely not. They've got huge amounts of capital that they can invest in this, massive free cash flow. They remain highly profitable. The question is whether they allocate that capital sensibly. The struggle they have, they can't make acquisitions. Can they manage to do what they've not done previously and innovate and disrupt a company that is already significantly at scale? It's a challenge, but it's by no means impossible.
All right, thank you both for joining us. Our Bloomberg markets editor, Christina Aquino, also busy with central banks, and Alex Webb from Bloomberg Quick Take. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. President Biden says his decision to send more troops to Europe is consistent with what he discussed with Russian President Vladimir Putin. The U.S. is posting about 2,000 extra soldiers to Poland and Germany, while 1,000 based in Germany will be deployed in Romania. Russia says the move is unjustified and destructive. The UK's energy regulator is set to announce the biggest increase in household gas and electricity bills on record today. Ofgem's new price cap, the maximum that companies can charge consumers, is set to rise by about 50% from April, reflecting soaring wholesale prices that would take average energy bills to over £1,900 a year. And a new super yacht for Jeff Bezos is so large that a Dutch bridge is being dismantled so it can actually be delivered. The Amazon founder's new 417-foot ship is being built in the Netherlands and needs to pass through Rotterdam to get to the sea. One Dutch politician says dismantling the crossing is really going a bridge too far. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Hey, what a story, Leanne. I just can't get enough of it. You kind of, you wish you were there to actually see what was happening and what everyone was thinking at the time. Our Leanne Gerrans. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. This hour, we speak to the former Bank of England MPC member, Andrew Sentence. You can send in your questions on IB plus TV Go. Also, up next, we're live from Threadneedle Street and from Frankfurt. We have a full Divergence chat. How do traders play the BOE and the European Central Bank today? This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it is decision day in Europe's two biggest central banks, and they're taking very different tacks and views when it comes to inflation. The Bank of England expected to deliver a historic back-to-back rate hike today and to give a timeline for quantitative tightening. The ECB, meanwhile, is expected to hold rates. All eyes will be on President Christine Lagarde's briefing for clues on how she will respond to the euro area's unprecedented inflation shock. Well, Bloomberg's UK economy reporter Lizzie Burden is out outside the Bank of England, and our anchor, Manus Krani, is in Frankfurt. So, Lizzie, let's start off with you, and good morning to you both. A rate rise from the Bank of England, but actually money markets are expecting quite a big hawkish stance from the Bank of England. Could they push back against it today?
Well, they certainly could, but policymakers behind me in the bank have been eerily quiet since December when we had that first hike of the pandemic. So we can only assume that they didn't want to push back on markets and economists' expectations of a rise to 0.5%. As you say, it would be the first back-to-back increase since 2004. So what, if that's baked in, economists and markets will really be interested in today is the future path of rates. And will Bloomberg Economics expects rates to end the year at 0.75%. Markets see them at 1% by June, and that's the level at which officials have said that they'll start active quantitative tightening. We'll be looking for clues in the inflation forecast and in the remarks from the governor. I know he'll be talking to you later, Francine. I'm interested to hear whether he emphasises the cost of living crisis, because that would signal that the bank's concerned about the short-term hit to consumers of hiking too steeply too soon. But if he emphasises the risk of a price-wage spiral, that would signal that maybe we can expect further tightening faster.
Thank you, Lizzie. And of course, Manus, when you look at some of the strong regional imprint that we had yesterday from the Eurozone, buttressing the euro, will that make it much more difficult for the ECB and Christine Lagarde to sound as dovish as she has in the past?
I think she needs to regrasp the narrative, push back against the pricing in the euro, push back against the pricing in the two-year yields. The message ING suggests is about patience and not panic. And when dealing with inflation, Francine, yes, the highest banner headline on record. But what's more important is to look at what's happening on the forward inflation expectations. And they are rolling over, according to Berenberg, on the 5-year basis. And therein lies her silver bullet, where she begins to redefine for the market when will the first rate hike come. If she uses the word, 2 words, makes it simple for me, very unlikely. Rate hikes this year, very unlikely. That is beginning the pushback against a market which is aggressively pricing 2 rate hikes this year, pulling them forward to July. And therein lies the problem, Francine. All central banks need to regrasp the narrative and arrest control away from the short-end interest rate traders, which are provoking the Fed and pushing the ECB and those 2-year bubbles.
I love that, Manus. Highlighter at hand. Yeah, Manus, highlighter at hand. Usually, we go through her speech to see how many times she said a word. It's one of my favorite pastimes. Thank you both for joining us, Lizzie Burden there and Manus Krani. So let's get more, of course, on the big central bank day. Moritz Kramer, chief economist and head of research, joins us. He's at LBBW. Moritz, when you look at the divergence between the Bank of England and the ECB, does it make each other's life difficult?
Good morning, Francine. Yes, I think the ECB is increasingly isolated in its stance. And I think Lagarde and Philip Lane need to come out of their bunker. And we've always heard, our decisions at the ECB will be data dependent and we will be patiently waiting for more evidence. Well, I think the evidence is there. I think that the data picture has changed quite a bit. And what we have seen since the December Governing Council meeting is sort of surprises on the upside in terms of higher inflation. We also have now sort of an unemployment rate which is below pre-pandemic levels, and we still have a monetary policy that's being calibrated against deflation fears. I mean, every single category on the price index is growing faster than the target. I really don't know what kind of data she wants to see coming in before changing tack.
So, Moritz, let's go actually to the flattening yield curve, and I imagine that will focus the minds maybe at the ECB. Lagarde so far has, of course, insisted that a rate hike is unlikely this year. Let's bring what the market is expecting. Money markets definitely skeptical. They predict a 10 basis point increase from the ECB by September. If you look at the inflation print, I mean, first of all, how did we get it so wrong? And by we, I mean everyone, almost every analyst and economist got it wrong.
Yeah, well, I think there's been the narrative. I mean, these things are driven by narratives, and we had this narrative of transition of inflation, and it's energy driven, and originally it was. But there's so much uncertainty, and if you look at the at the press conference in December, the word uncertainty was plastered from beginning to end all over the place, but they're behaving as if they knew for sure. And I think that's really where you're not very well positioned for negative surprises, as we've seen them now. What I see, speaking to clients here in Germany in particular, and I'm sitting here in Stuttgart, which is of the industrial heartland. I speak to clients; they all expect a significant pickup in wage demands. They all have plans. The vast majority have plans to hike prices. So the wage price spiral, which is what central banks fear the most, is about to begin. And just ask the Fed how difficult it is to reel that in once you lost control over it at the beginning. So I think the narrative in Frankfurt needs to change. There needs to be more caution. And I think the markets are really pushing for that.
Yeah, and we see it. I mean, if you look at some of the inflation numbers, and we charted it and brought it back historically, I mean, it's really quite surprising, the pickup, the pace of pickup, and the trend that could be here to stay. So the focus for investors today is whether Christine Lagarde will turn more hawkish. But how does she do this balancing act?
Well, we'll find out. She has been pretty much stonewalling so far, but they've been dropping the transitory argument increasingly. Now the facts have changed. We are hanging this whole monetary strategy on a forecast by ECB staff for inflation next year and 2024, which is 1.8%. And if you listen to the ECB, they're saying, well, that's less than 2%. That's below the target, and that's why we need to continue to go full throttle. But we're close to the target. That means we should also be close to the steady state monetary position. And frankly, these 0.2 between the forecast and the inflation target, that's a fraction of the average forecast error that ECB staff has done over the years.
All right, Moritz, thank you so much. Moritz Kramer, their chief economist and head of research at LBBW, stays with us. We have also some great charts looking at the Bank of England and some of the market pricing around that. Also, technology always in focus after that disappointing figure from Meta. I was speaking to Richard Windsor this morning with a great note out saying maybe the market is overdoing it because, yes, they disappointed, but it wasn't also that bad. You can see it not only broadening out to some of the technology that we're used to using during the pandemic, but also infecting the broader market. Meta, pre-market, down 19%. Snap down 15%. Even Twitter's actually being held down some 8% lower. Coming up, more on what should we expect from the Bank of England today. Inflation shocks on the continent, also in Europe. We continue our conversation with Moritz Kramer. You can send in your questions on IB plus TV Go. This is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
How difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So turbulent day for the markets. We have policy decisions from the Bank of England and the ECB coming up. We're back with Moritz Kramer. Moritz, let me bring you to my chart on the Bank of England. This is a fantastic chart, and the real question that markets really wants to ask themselves is, will they push back against the market pricing by projecting, for example, that inflation could be below 2% in the medium term? And this is what the market is expecting. So market pricing, 1% policy rate by June 22, and Bloomberg Economics does not see a 1% until the first quarter of next year. What are you expecting the Bank of England to do this year?
Well, I would concur with the market expectations here. I think if the Bank of England would have wanted to push back on the expectations that are sort of priced in, they would have had plenty of opportunities. They chose not to. I mean, we've heard from Lizzie and others on the program before that they've been very quiet, which is, well, uncharacteristically quiet. So I think they're happy to see those expectations developing, and I think they will conform with those expectations.
But, you know, there's a clear desire, I guess, to show that, you know, they care about price stability. So you're expecting a hike today, no question asked. The rest is going to be a lot more difficult, right?
No, I think there will be a hike today. I think there might even be a sort of a unanimous decision on the hike, and unanimous decision, in my mind, is always a sign that you somehow missed the boat. So it's so obvious what you have to do that you know, there's not even a minority view on it anymore. So the Bank of England knows that there's more sort of price pressure built in, especially when sort of the gas prices go up in April. And they, as the Fed, are quite worried about wages going up, and we have a really hot labor market. So this is a real risk.
Moritz, thank you so much. I know. And the big question, of course, on QT. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Meta's mega miss. Facebook's parent plunges as user growth stalls for the first time ever. Nasdaq futures point to the downside. Policy split. The Bank of England is set to leave the ECB in the dust by lifting rates and signaling more to come. We're live in London and Frankfurt. And stay with Bloomberg Surveillance Early Edition. This hour we speak to the former Bank of England MPC member, entry sentence. He's never dull and always on good form. Send in your questions on IB plus TV Go. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. The market's also never dull, especially on a day where the Nasdaq was really dragged lower by Facebook. This is also impacting a lot of the other markets and assets. I'm looking at commodities. They're on the way up. It seems that GDP and general output is okay. If you look at technology, a lot of companies coming out with notes are saying, are we overdone with the selling? If you look at Snap, it's also down significantly in pre-market. I think Facebook, or Meta, as it's called now, down another 19%. Technology stocks in Europe also feeling the brunt, and Nasdaq futures down some 0.2%. However, away from technology and away from earnings, it's all about central banks. If you boil it down, let's make it simple so that traders can actually use some of the things that we chart on Bloomberg for you. The question is whether and how you play this divergence between the Bank of England and the ECB. The market clearly pricing in a 1% policy rate for the Bank of England by June of this year. Bloomberg Economics, however, does not see that 1% until the first quarter of next year. The main question is, will the Bank of England today push back on this aggressive market pricing? Unlikely, but also the other main question is, could they actually become as hawkish as Jay Powell was at the Fed? So the ECB must now decide how to respond to euro area inflation shock as well. That's prompted traders to ramp up bets on interest rates being lifted. This week's Governing Council meeting comes just as inflation unexpectedly surged to 5.1% in the year to January. We're now joined by Pooja Kumra, Senior European Rate Strategy at Toronto Dominion Bank. Pooja, always great to speak to you. Thank you so much for coming on. I mean, this is a terrible and difficult balancing act for Christine Lagarde after that inflation print yesterday. Can she still stick to her line, no interest rate increases in 2022?
Good morning. Yes, a very big move yesterday. Markets are pretty much spooked by the inflation prints, and we are pricing in 25 basis points in hikes by end 2022. So a meeting that was supposed to be uneventful, I think she needs to be more assertive when it comes to reinforcing the fact that ECB's current guidance, which is changed guidance on QE, that will continue at least until September, and rates raising after shortly is maintained. So I think she would try to be more assertive, just given the fact that if she leaves markets clueless, they would actually start pricing in an end of QE as soon as June and a possible rate hike. So that 25 basis points in rate hikes can very quickly become 50 if Lagarde is not assertive enough. She's already told us that ECB is not following the path from Fed. We are a different country, and the growth fundamentals here are different. So I think that's what we want to see right now, how assertive she is.
Yeah, but how does she look at the, flattening German yield curve? Yesterday, certainly they flattened even more. I think we have that chart that we can show all of our viewers and also radio listeners. At what point does she actually cannot fight the market anymore?
I think most central banks try to avoid focusing much on rates per se because they don't want to target a German or a BTP yield curve. But this is the trend that we are seeing in all three curves, with G3 curves, just because markets have been so aggressive on pricing rate hikes, whether it's 5 rate hikes for Fed or BOE. That's why we are seeing this aggressive bear flattening. The moment she pushes back against any rate hikes in 2022, we would actually see more steepening, just given the fact that 2022 is a year where we are saying goodbye to PEPs, we are saying goodbye to APP. That means all QE support is ending. So that's where we could see steepening happening if we do see a pushback on rate hike front.
Okay, let's have a look at what happened overnight, right? Which is we saw swings in the euro, and I think we also have a really other great chart looking at some of the sub-zero bonds that had touched the 3-year low. Currently, okay, the Governing Council is expected to stay pat for the moment, and everything hinges on whether Christine Lagarde says very unlikely. Again, how does she sound hawkish without completely dismissing what she said so far?
I think if they are considering 2022 hikes, they would start talking more towards more inflation upside risk. That would be our first clue that they are trying to actually push forward key decisions till March. But I doubt they will be very forceful on the inflation forecast right now, just because for now they are still have the December forecast, which see inflation below the 2% in 2023 and 2024. So I think a more firmness could come more in the March meeting. Right now, I think they will just acknowledge the fact that their risks to inflation are definitely higher. And that's not the case for Euro, it's the case for even BOE as well as Fed.
I don't know if we can look at hindsight, but actually, how could the ECB have kept a firmer handle on what market is pricing in her to do? Because now it's a bit of a communication nightmare.
Yes, definitely a communication nightmare. So far, everything was well managed because markets knew that they have an APP going on forever. They have a PEP. So now, as we are approaching the end of QE program, ECB's current guidance is very weak. And that's not giving markets any direction. So the moment QE ends, shortly after they will be hiking rates. So I think there she needs to basically give more of a time guidance. You remember Draghi did do this once. When he was ending QE program, he basically told markets that we are not hiking rates for a year's time. So this could be a possible way that Lagarde could actually push back on rate hikes. But it just seems that right now they are also uncertain. They need to actually provide us with a firmer guidance. Otherwise, Euro can really sell off from here.
Pooja, I know we can't talk about transitory anymore. This is like a banned word. But what exactly happened with that inflation print yesterday? Is it wage growth? And how did we not see it coming?
Yes, definitely energy prices continue to actually have an impact on the inflation numbers. But what we're also seeing is that the core inflation is picking up, which means that the wage inflation has also started to increase. I think what would be key right now is the next couple of months will be the time where there'll be more ECB will have firmer grip on how much of the wage effects that they can see in the inflation. And if that has a stronger hold, then definitely we could see rate hikes coming as soon as, I would say, possibly first quarter of 2023, just because they have committed to end the QE program. They have to end the QE program before even starting off the hiking cycle. But actually pricing something like 75 basis points of hikes by end 2023 is something that's not ECB style. They give proper guidance, they give market more notice. And I think that's what, at this stage, they will lose credibility if they do not stick to that.
Yeah, I mean, there's a number of things, including supply disruptions that maybe were minimized in the euro area. If you look at German GDP, it's really left it on the brink of a second recession since the pandemic began. Pooja, are we now seeing the whites of inflation's eyes? I love that phrase that I think we had from Trichet over the years. Is this the moment? Is it crunch time?
Well, we expect that we could see more higher numbers in the coming months before it actually starts slowing down. So we are keeping an eye on energy numbers as well as how much, as you said, we can't use the word transitory, but I think so far it is being transitory. And even if we have China following the zero COVID policy, the impacts will be felt for longer. But I think clearly by June, if the forecasts continue to have these upsides, I think ECB will take a tougher stand. But I think before March, actually thinking that they could hike as soon as 25 basis points for December is too much right now. And I think that's where Lagarde will try to push back.
Thank you so much for being with us, Pooja. Pooja Kumar, I know she'll be also with her highlighter, like I will be, to see how many times Christine Lagarde uses certain words. Senior European rate strategist at Toronto Dominion Bank, joining us today. Now, coming up, the Bank of England expected to complete the first back-to-back rate increase since 2004. And we'll be joined by the former MPC member, Andrew Sentence, who thinks the bank is getting its forecasts badly wrong. It's going to be an interesting conversation. Don't miss it. It's up next. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the Bank of England could deliver a historic back-to-back rate hike today in a bid to curb inflation. The central bank is also expected to take the first steps towards unwinding some of its stimulus program. But one former MPC member is calling for a robust review of the committee's performance. Now, in an opinion piece in The Times, Andrew Sentence criticizes the central bank for getting forecasts badly wrong. He argues that diversity of debate has faded away and there is too little focus on long-term strategy. I have to say it's a punchy opinion piece, and Andrew Sentence joins us now. Also with us is Jamie Rosher, Chief European Economist at Bloomberg Economics. First of all, gentlemen, let me also bring you to the chart of the hour, if not the chart of the week, which goes on to market price expectations of what the Bank of England can do. Now, market is pricing in a 1% policy rate hike by June of this year. Bloomberg Economics does not see that 1% until the first quarter of 2023. So at play is really whether the Bank of England today will also push back against this market expectations. Andrew, it was a punchy opinion piece. So first of all, why do you think the Bank of England is getting forecasts so wrong?
Well, I think there's a tendency in the bank just to see rises in inflation as a temporary phase. And there's obviously a lot more going on in the economy than just some of the temporary factors like higher energy prices or global supply chain shortages. But the bank has been very slow to recognise that and acknowledge that. And you'd think I think they've got a team of about 50 economists in their monetary analysis division. They would have picked up on this sooner. And so it causes me to think that there are more systematic problems with the Monetary Policy Committee that need to be fixed.
Andrew, I want to go to our chief economist in a second, but actually the Fed has also had the same issues. The ECB, I mean, they were surprised by that 5% inflation print. So is this a wider problem for central banks as a whole? I mean, what's even going on for what economists are expecting?
Well, I think the diversity of view on the Monetary Policy Committee is not what it used to be. We used to have very lively and active debates. And if you look at the votes cast on the Monetary Policy Committee, there are perhaps one or two dissenters. But there hasn't really been an active debate about alternative views of how the economy is performing. And the whole purpose of having a 9-strong committee is that you get a diversity of view and you get a proper debate about what's happening in the economy. And it seems that the MPC and its monetary advisors, as the bank economists, have settled down with a view about the way the economy operates, which is not necessarily correct.
Do you agree with that, Jamie? It seems that, you know, the Fed will say actually the MPC is still very diverse compared to some of the conversations that are ongoing in other central banks.
Sure. I mean, I think it was a surprise to us that so many people jumped on the bandwagon to start hiking earlier this year or late last year. And, you know, whether you agree with the policy decision or not, it probably is a problem that if you think that there's groupthink could be a problem at the Bank of England, then, you know, there is perhaps some evidence of that. And I have some sympathy for Andrew's view on that. On the forecasting errors, but I think, as you say, Fran, it's not something that's unique to the Bank of England. The ECB have suffered from the same problems, the Fed even more so to some extent. And actually, to get the forecast right, you have to know the internal workings of Vladimir Putin's mind, you know, like to understand what's going on with energy costs. And there's only one person. That easy
thing of mind reading Putin.
Exactly. And, you know, there's only one person who knows the answer. So I think I agree with Andrew that there are forecast errors that, you know, on reflection, perhaps that shouldn't have been made, but a big chunk of it is unavoidable.
Yeah, Andrew, do you think, I mean, again, there will be a lot of pushback on some of the things you were saying, but is this because a lot of meetings are held on Zoom? Is it because of the pandemic and it's just much more difficult to forecast? And again, as Jamie was saying, you know, energy prices, frankly, are just all over the place.
I think it's not just to do with energy prices. I think that's a misreading of the situation. We have many factors that are pushing up inflation. And when we look at the inflation forecast, things like skill shortages and what's happening in the labour market could be actually more important over the medium term. I think there was a misreading of really what shocks hit the economy in the pandemic. It was seen predominantly as a demand-side shock, but actually it was a supply-side shock as much as a demand-side shock, and perhaps even more so. So that's left us with an impaired capability in the supply side of the economy, which we can see through the figures on vacancies, for example. And therefore, the monetary response should have been much less accommodative, and we should have had an earlier tightening in monetary policy, perhaps starting last summer, perhaps at the latest.
I mean, certainly it was priced in towards the end of the year with the markets being really surprised. Andrew, I mean, what should we do about it? What should the bank, I mean, if they think you're right, and I'm sure there will be a lot of pushback from the Bank of England, how do you propose to deal with that?
Well, I'm suggesting that the Treasury Select Committee, which is part of the parliamentary scrutiny of the Bank of England, should take a much longer-term review about how the committee is operating now and how it's dealt with both the aftermath of the global financial crisis and the episode of the pandemic. We had a similar review, but that was 15 years ago. That was after 10 years of the MPC. We're now getting to the 25th anniversary of the MPC. And it's quite surprising we haven't taken a good look, given all the shocks that we've had in the economy, at how the committee is operating and whether it's actually doing what it says on the tin, which is to contain inflation, to be our inflation watchdog.
I mean, Jamie, if you look at the proposition of Andrew of hiking in mid-2021, I mean, that would have sent market gyrations to like a new level of crazy almost.
Well, yeah, I mean, to get inflation to target by the end of this year, you'd had to have started lifting rates in the second wave of the pandemic. So it's not obvious to me that you'd ever have been able to manage away an overshoot of inflation this year or even by the end of this year. I think, I mean, on whether the MPC needs to be reviewed, I mean, there have been reviews, they just haven't been political ones. I mean, in the sense that the monetary policy framework was reviewed by the Treasury, 2013-14, around that time. We've had the bank kind of introspective on itself under Carney's tenure. So I mean, there has been some shake-up, but I'm not, perhaps, but I agree, it could be worthy of political scrutiny.
Andrew, I mean, how high do you think rates need to go, and what's the new equilibrium?
Well, I'm still in favour of a gradual rise in interest rates, but if you're going to have a gradual rise in interest rates, it has to be quite consistently followed through. So there are some people arguing for a 0.5 or 0.75% rise today. I think that would appear to be a knee-jerk reaction. But I think what the MPC should be doing today is raising by a quarter and then signalling quite clearly and then following through on that signal that they're going to gradually increase interest rates to certainly somewhere between 1 to 2% by the end of this year, and then further out into 2023, perhaps to somewhere around about 3% or so. I think there's still a hope for a gradual rise in interest rates, but if things are put off and delayed, that becomes a much more difficult thing to achieve.
Andrew, I also want to give a massive victory lap, actually, to our own Bloomberg economics team. First of all, this is market expectation going forward, and then the victory lap, Jamie. This is what we're seeing. So markets pricing in a 1% policy rate by the Bank of England by June of this year, but Bloomberg economics does not see it until the first quarter of 2023. Massive victory lap, because I think even Governor Bailey at the end of 2021 said that we were one of the only ones to get it right in not predicting a hike. Right. So why are you pushing back against market expectation, Jamie?
So my kind of general view on the UK economy is that it's not like the US. I mean, we do have labour market tightness. Andrew's right that services price inflation is picking up, and there are indications that there's a firming of pressure. But I don't think we need a Fed-style hiking cycle in order to keep those things in check. So at the moment, I mean, the bank is basically expected by markets to do what the Fed's doing. I think it'd be a much more comfortable position to be somewhere between what the ECB is likely to do and the Fed, but not all the way or at the extremes.
Oh, it's exciting. I'm really excited about actually this Bank of England decision, so we'll see what happens, and we'll have to get you both back on. Andrew Sentence, former member of the bank's Monetary Policy Committee, and Jamie Rush, our chief European economist at Bloomberg Economics. Now, coming up after that meta sell-off, we look ahead to Amazon's upcoming results. That's coming up shortly, and this is Bloomberg.
this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project. Initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now let's get back to our top story and that huge sell-off in shares of Facebook's parent Meta, plus a look ahead to Amazon's results. With us to discuss all of this is our Bloomberg anchor, Danny Berger. Danny, first of all, you make everything fun, so I'm so happy to talk to you about this. I mean, it's very clear that, look, Meta reported, some results that kind of flatlined, and the market's freaking out. Is it the boomers suddenly selling their shares saying, oh no, no one's looking at this anymore?
It does. It definitely feels like there's an element of freak out. 20% drop, that would be the biggest loss in market cap any company has ever seen in one day. Though if I were to try to justify it and do it in a wonky way, which I feel like I have to do, you could say, you're welcome, you could say, okay, these types of big tech stocks are priced for their future value. Yeah. So you're in an environment where we're getting rates rising, and all of a sudden you're questioning the business model, that only random boomers in Italy are using Facebook right now. So what is their business model? My
family's guilty.
Only Francine's family is using it. So what does their business model look like? If you're reevaluating it, that's when you get this panic. That's when you get this huge drop in share prices.
Yeah, the thing is that Snap was down 10%.
Yeah.
Then you have Qualcomm, pretty good results, but they were also significantly down. And they're investing so much on the metaverse. I mean, is this not going to pay off?
Well, if it does, it will take a while. I feel like it's just a big question mark, and for now, it's just a cost. But I do think it's interesting to see the tech giants not trade as a monolith anymore. There are now differences between businesses. Google solidifies its lead. Facebook falls behind.
Amazon, there's nothing I don't buy on Amazon.
Yes.
Guilty as charged.
Yes, you and me both. Look, it's going to be a tough quarter for them. They have tough comparables. There's a lot of macro influences. Shipping costs are high. Labor costs are high. So analysts aren't expecting the best of quarters, which could just add to the unpleasantness of tech today.
All right, look out for the unpleasantness. It's also, of course, selling off in Europe and broadening to that market sell-off as a whole. Bloomberg anchor Danny Berger. Fun as always, even when the news is not good. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kay Lyons are in New York. Anna Edwards is in London. A full roundup, of course, of central banks. We have Bank of England. We have ECB. How do traders play that divergence? This is the only question you need to ask yourself today. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
It's a dance between the Fed and markets. I think the frothier areas of the market will continue to have headwinds.
I think that in 6 to 9 months, we're going to be having a very different conversation around inflation and demand.
If we're talking about a systematic tightening of global financial conditions, that's not as friendly an environment for equities.
Maybe I'm old school, but I think earnings do matter and will continue to matter.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
Markets feel the Facebook aftershock. The rally in global stocks falters after the social network's parent plunges more than 20% following a disappointing forecast. How quickly will central banks move to tamp down inflation? The Bank of England is expected to deliver another interest rate hike today, but guidance for 2022 is in focus at the ECB. And rising prices are likely to be the focus of a Senate confirmation hearing today. President Biden's 3 Federal Reserve nominees all say that fighting inflation is a top priority. Welcome to Bloomberg Surveillance, everybody. This is the early edition. I'm Anna Edwards in London, Matt Miller and Kaylee Lines in New York. Good morning, everybody, and good morning, Kaylee. It seems that European equity markets doing their best to try and ignore that sell-off in tech, but they can't.
Yeah, and Asia really couldn't either overnight, Anna. Granted, there are still a number of markets that were closed for the Lunar New Year holiday, including China, Hong Kong, Vietnam, Taiwan. So only a few regional gauges were trading, but most of them, including Japan, were lower, taking the MSCI Asia Pacific Index down about 0.4%. There was one exception, though, and that was South Korea. The Kospi rising about 1.7%, maybe just catching up to the gains we had seen here in the U.S. over the last 3 days, catching up to that rally. It may be a different story tomorrow, depending on how this U.S. session shakes out. And you definitely saw a bid into haven assets like sovereign bonds overnight. That included Australia, where the 10-year yield came in about 5 basis points. I also wanted to point out in the commodity complex, iron ore gaining for a third day. There's a lot of optimism that policy easing in China will actually lead to some support for the industrial economy there this year. And as a result, iron ore futures were up 3.5% overnight, north of $140, Matt.
All right, we'll be watching that, and of course, we'll all be waiting for your pre-market movers today to see what Meta looks like this morning. It's really dragging on NASDAQ futures. You can see they're down now more than 2%. I think this is the focus today rather than the S&P 500, which, by the way, has had a fantastic 4 days, up from 4,300 to basically 4,600 in just a few trading sessions. The U.S. 10-year yield is down at 1.7734, so investors are buying bonds, maybe looking for some kind of safe haven there, and maybe looking for it in the Bloomberg Dollar Index as well. At 1179 right now, the dollar index gaining about 0.25%. Crude is down, but this is New York, still holding at a relatively high level, 87.33, and we're still looking at Brent crude that's up about $89 a barrel. So even with the production boost from OPEC, or the production boost pledge, because how much spare capacity do they really have left, we see oil holding strong. Anna?
Yeah, how aspirational are those pledges we're getting these days from OPEC and OPEC Plus? Matt, to your point about the NASDAQ being really in focus, and of course it is with those Meta earnings, how is Europe responding? Well, it looks really red, and it is, and we certainly have some weakness coming through in technology over in this part of Europe in particular. The London market holding up a little bit better, down by 0.2%. We can show you what the FTSE 100 is doing right now, and it is in negative territory. It spent much of the morning, though, actually just keeping its head above water in positive territory, but now we do see some moves to the downside. It's basic resources moving as higher, it's energy stocks moving as higher, and other earnings stories, even a catering company through the Omicron pandemic, pleasing the markets with its earnings statement today. But there is no ignoring the technology downdraft, and that's what we see here in Europe as well. The technology sector down by 2%. Even a company like Infineon, which is a chip maker, which chimes with the positive news flow we've seen from Qualcomm. They were guiding the markets higher, Infineon, just this morning. Even with that, we see that sector under pressure, that stock under pressure, as chip stocks are being taken to the downside along with those social media names. So Shell is in focus, up by 0.9%, so really bucking the trend when it comes to energy majors here in Europe. We've had a buyback pledge coming through. More detail on that, more aggressive on the buyback from Shell, and so that is something that is moving the market this morning. Roche Holdings, the pharma company over in Switzerland, down by 2.8%, a little conservative perhaps on the guidance. That's some of the messaging coming through from analysts this morning. We spoke to the CEO of Roche, Severin Schwan, a little bit earlier on today, and he was saying he gave some forecasts for how he thinks the pandemic will play out, and acknowledged there's a huge amount of uncertainty, Kaylee, for a business such as Roche, such a giant of pharmaceuticals, but that has made a lot of money out of diagnostics and testing essentially around COVID-19. Where the pandemic goes, how it becomes endemic, really crucial.
All right, well, we will continue to follow the movement for some of those earnings stories. We also will follow the downdraft for technology more broadly, but there is a lot more ahead today, including some important monetary policy decisions. The Bank of England's rate decision will be at 7 a.m. New York time, followed by the ECB at 7:45 a.m. The question is, with a market that has dramatically repriced tightening expectations for both of those central banks, how do they respond today? We will also get here in the U.S. some economic data, including initial jobless claims and durable goods, setting us up for the payrolls report tomorrow. And finally, tech earnings continue. The last Titan will report Amazon due after the bell, Matt. And of course, sentiment is not great in this sector going into that print.
No, absolutely not. But of course, we did get good Google earnings, so we'll see what Amazon shows us this evening. We're going to get more on Amazon in just a moment. First off, I want to get shares of Facebook's parent Meta Platforms. They are plunging after a disappointing earnings report and outlook. This drop could potentially erase $24 billion from Mark Zuckerberg's personal fortune. Bloomberg's Danny Berger has more on the tech fallout. Danny?
Yeah, $24 billion in his personal fortune, nothing compared to what what Meta looks like it's about to wipe out. A 19.5% drop so far pre-market. Back of the envelope calculations, that's just under $180 billion wiped from market cap of Meta. That would be the biggest loss for any single company in one single day. Now, the issue really for Meta and all of these tech giants is that their pricing is very far into the future. That's how we evaluate them when it comes to valuations. So So in an environment where rates are rising, if you have questions about their business model, that's when we can get these really big losses in market value. And for Meta, it's a question of, can they keep up user growth? Are the kids all just now using TikTok, so competition means they can't stay afloat? And it's bad news for the NASDAQ as well, because Meta is 5% of the NASDAQ 100. Sentiment seems to be turning. NASDAQ futures, Matt, you're putting them out earlier today, falling about 2%. So this bounce that we saw previously in previous weeks, the concern with these Meta earnings is that that was just a dead cat bounce, and now we resume this downward draft into a bear market for big tech.
But can Amazon swoop in and save the day, Danny?
That is probably what a lot of folks are hoping for. And it is interesting to see this earnings season that tech isn't trading as a monolith. You have companies like Alphabet who can solidify their lead, Meta that seems to be falling behind. Will Amazon be falling behind? It has a lot to live up to when it comes to the cloud and really strong results from Google. Of course, it's getting caught up in this tech downdraft this morning, down 3%. But I have to say that analyst chatter around Amazon isn't exactly positive. They are an encapsulation of the macro headwinds that the entire world is facing right now. We have people less observing of those pandemic trends, maybe ordering less online, but also Amazon has cost issues, shipping, supply chain issues. That's really expensive for them. Also, we are at full employment in the US, so labor costs are rising, and it also means it was likely harder to fulfill a lot of the holiday shipments. So a lot of negative headlines around Amazon, but of course, Anna, that low base might mean that Amazon can surprise the upside today.
Absolutely. The twists and turns of the technology story just this week. Yeah, absolutely. High drama, high market drama, and we'll look for the read across. Thanks very much, Danny. Bloomberg's Danny Berger with the latest on the tech sector. Now, back to the central banks. It is decision day for Europe's two biggest central banks. The Bank of England is on the verge of another rate hike. Meanwhile, the ECB is set to decide how to respond to an inflation shock. Bloomberg's UK economy reporter, Lizzie Burden, joins us from outside the Bank of England, and Bloomberg's Manus Cranny joins us from outside the ECB. We felt the need to send you both into the cold to report on these stories. Lizzie, if I come to you first, a rate rise from the Bank of England today seems like a done deal. So what are we expecting today in terms of clues about the future path for tightening? A lot of talk about the cost of living here in the UK.
There is a lot of talk about it, and we're set to get an announcement later on from Ofgem, the energy regulator, on how much the price cap for energy bills is going to rise, and a statement from the Chancellor Rishi Sunak on how the government's going to respond. But I'm outside the Bank of England, and policymakers in there have been eerily quiet since December, when they hiked interest rates for the first time in the pandemic, surprising markets. And we can only assume that that silence is because they don't want to correct the assumption of markets and economists that they're going to hike rates to 0.5% today. It would be the first back-to-back increase since 2004. And if that's a done deal, what markets will be listening to is how fast and how far the bank's going to tighten across the year. So Bloomberg Economics sees interest rates ending the year at 0.75%. Markets, however, see them at 1% by June, and that's the level at which officials have said that they'll start active quantitative tightening. We'll be looking at the inflation forecast and listening to the governor, because if he emphasises the cost of living crisis and concerns about that, it could signal that the bank's worried about tightening rates too quickly and the hit that would have to consumers in the short term. But on the other hand, if he emphasises the risk of a price-wage spiral, that could signal that we're going to get further tightening fast.
Okay, important. That's the stuff we need to watch out for then. And we could get further news on the passive side of quantitative tightening as soon as today, couldn't we, Lizzie? So that's the Bank of England story. Manus, let's turn to you and the ECB. A lot of pressure then on the messaging from the ECB, and to what extent they can really stick to this suggestion, this belief that there won't be rate hikes in 2022.
Look, absolutely. Christine Lagarde and the ECB need to regain the narrative and the upper hand from the market, because the market is baying for 2 rate hikes by the end of the year. And indeed, we saw elevated pricing yesterday in the market up to a rate hike in July. And Christine Lagarde needs to convey patience over panic. And when it comes to the narrative around inflation, it's one of, this is still deemed transitory or elevated, but not enduring, so to speak. We know Powell binned transitory pre-Christmas. The question for Christine Lagarde will be 2 words: very unlikely. In other words, a rate hike this year, very unlikely. If she really labors that point, is trying to re-grasp the narrative back from the market. Yes, she faces the strongest inflation in our lifetime here in Europe. But when you look at the forward expectations on inflation, Anna, they are rolling over. Yes, the short end of the curve has moved very aggressively, 17, 18 basis points since the FOMC just a number of days ago. So the market is pushing and putting pressure. Lagarde, well, we know that this woman wasn't for tapering in the autumn. It sounds as if she's very unlikely to be for tightening in the spring.
All right, Manus, thanks very much. Manus Cranny there standing outside the ECB in Frankfurt, and thanks to Bloomberg's Lizzie Burden as well at the Bank of England. Stay with Bloomberg for our coverage of the rate decisions and news conferences from the BOE and the ECB. It all starts at 7 a.m. in New York, 12 noon London time. Let's get over to Washington right now. President Biden's 3 nominees for the Fed appear before the Senate today. Republican members of the Senate Banking Committee have already expressed concerns over both Sarah Bloom Raskin and Lisa Cook. Senator Pat Toomey spoke with Bloomberg yesterday.
The nature of that concern is her longstanding, repeated, explicit, and recent advocacy for the financial regulators generally and the Fed in particular to allocate credit specifically away from fossil fuel burning industries.
Jack Fitzpatrick, Bloomberg government reporter, joining us now from Washington, D.C. Jack, so what do we know about the timeline and the likelihood that these nominees are confirmed?
Well, we know that they're going to come up against some Republican pushback, barring really impressive performances in today's hearings. There hasn't been a lot of pushback from key Democrats just yet, but we'll have to see how these hearings go. As you heard, one of the main points against them from the conservative members is any focus on climate change and fossil fuel and sort of slipping into more regulatory focus that has come up in Sarah Bloom Raskin's career. The other knock on one of these candidates is Lisa Cook's experience in economics. A lot of her academic experience has been more sort of on the economic history of African Americans, and there's going to be some questioning as to exactly how directly her experience ties into monetary policy. So you heard some issues from Senator Toomey. We heard from a senior member of the committee, Richard Shelby, who also said he's got issues with the experience of Lisa Cook, and I think those two are going to be the knocks against them that you hear today.
All right, so that's what's going on in the legislative branch today. Let's talk about what the executive and President Biden is dealing with. Obviously, still geopolitics. Biden spoke with French President Emmanuel Macron last night about Ukraine. But the president is also focused on domestic issues, and he's heading here to New York today to promote his administration's efforts to fight gun violence. Jack, what can we expect?
Yeah, so he's going to New York. He's going to be meeting with the new mayor, Eric Adams, and they're going to talk about gun violence and the response to gun violence, obviously with the recent shootings of 2 police officers there. The president is going to play up what he's done for state and local governments, money that's gone to state and local governments, and how that ties into pushing for putting more police on the streets. Obviously, politically, it's a long way, what you're hearing from the president, from any sort of talk of defund the police that you heard from some Democrats recently. So this combination of President Biden meeting with Eric Adams at least is going to play up Democrats who want to send a message to the public that they support the police, and particularly funding for the police.
All right, Jack Fitzpatrick of Bloomberg Government in D.C. for us. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. Of course, we talked about the fact that Meta was plunging. It is taking other social media stocks down with it. They could face a lot of those same headwinds, including Snap, which reports after the bell today. And ahead of that, it's down 14.3%, 15.3% even before the bell. Another stock moving to the downside is Spotify. It reported yesterday subscriber expectations for the first quarter coming in well short of estimates. As a result, that stock is down the better part of 8%. And one other mover to the downside is Qualcomm. It did beat on the top and bottom line. It's still supplying a lot of phone chips. That's not the issue. The issue is if it can expand into autos, the Internet of Things. It doesn't look like it's having much success with that given some of the shortages that are out there. And as a result, that stock is down the better part of 4% before the bell, Ina.
Yeah, interesting to see Infineon in the chip space down here in Europe, despite guiding higher. When we come back, we will talk about the earnings story. Weak earnings and upcoming rate decisions weigh on the markets. Hannah Gooch-Peters joins us, global equity investment analyst at Sanlam Investments. And on the Bank of England and ECB decisions, Chris Hare, HSBC senior economist, joins us. This is Bloomberg.
Has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid. It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
Welcome back to Bloomberg Surveillance Early Edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards is with us in London. We're also going to bring in Ven Ram right now, cross-asset strategist from the all-important Markets Live blog. And Ven, I wanted to start with a look at the German two-year yields. We've seen an absolute surge, 6 or 7 sessions in a row of gains, now up to negative 47 basis points. How much does this affect the ECB and Christine Lagarde's decision? Germany obviously is a huge part, the engine, if you will, of Europe's economic growth.
Morning, man. Absolutely. It does put some pressure on Christine Lagarde right away. If the front end uncorks and moves higher, and it's now about the deposit rate, and that is kind of signaling that the markets are ahead or pricing in ECB tightening. Now the markets are saying go, 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 but the ECB will find itself saying no, no, no. Given that they set out their stall in December, they are unlikely to do anything just yet. If inflationary pressures continue to persist beyond the first half, they will stop their asset purchases and then review the plan as they go.
Okay, I love that summing up. The market says go, 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 and they say no. Ven, let's turn to the Bank of England. We have a high expectation that we get a rate hike there. What about quantitative tightening, though? Because they'll get their base rate to the level that they've previously said would be the point at which they'd start, passive at least, quantitative tightening. Will we hear more about that today?
Absolutely. I think that, their guidance on how they plan to accommodate that tightening is going to be very important. How are they going to run off that balance sheet? Now, as you mentioned, Anna, we are going to get the passive quantitative tightening, starting with the if they move the benchmark rate to 50 basis points. But at 1%, they will start to consider active selling of gilts. Now, when is that going to come? And are they willing to bring it forward is a key question for the markets. Because if you look at the UK's yield curve, it's the flattest anywhere in the G10 world. It's like 23 basis points at the 2/10 points of the curve. And that is not inspiring at all from a BOE perspective. So they may want to bring it forward, their active sales, so that the yield curve kind of widens, because it doesn't serve them any good to have the yield curve this narrow.
Okay, thanks very much, Ben. Ben Rahm of the Bloomberg Markets Live team. Remember, you can get market analysis. Check out MLI Vigo on the terminal. This is Bloomberg.
Variant and the latest wave have an impact on not only consumer trends but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's time now for the first word news, and the U.S. is seeking to send a stronger military message alongside its diplomatic efforts in the Ukraine crisis. It's sending about 2,000 soldiers from the U.S. to Europe in the coming days, and 1,000 troops based in Germany will be sent to Romania. Russia quickly criticized the moves. Meanwhile, on the eve of a meeting with Xi Jinping, Vladimir Putin said that Russia and China play an important stabilizing role in international politics. Putin is heading to Beijing for the opening of the Winter Olympics. The two countries have been expanding their political, military, and economic ties to counter the West. Coming up, we'll have more on geopolitics and more on these markets with Hannah Gooch-Peters, global equity investment analyst at Salem Investments. This is Bloomberg.
Estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
I think that it's hard to put your head around any narrative. Like, be honest, we've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Here is what you need to know. Shares of Facebook parent Meta are plunging. The social network's user growth faltered in the first quarter, the first stagnation in its history. That is stoking concerns that Facebook has plateaued after years of consistent gains. Could Amazon save the tech rally? We'll find out when the company reports after the bell. How quickly will central banks move to tamp down inflation globally? The BOE is expected to deliver another interest rate hike today. Inflation in the UK is at a 3-decade high, and it's set to rise further. Meanwhile, guidance for 2022 is in focus at the ECB as Christine Lagarde decides how to respond to an unprecedented inflation shock. And all three of President Biden's nominees to join the Federal Reserve say they place a high priority on tackling inflation. Prices in the US are rising at their fastest rate in almost 40 years. Philip Jefferson, Lisa Cook, and Sarah Bloom Raskin appear before a Senate confirmation hearing today. That's a look at what you need to know this morning. Matt, the focus undoubtedly on technology as we head towards the start of trade.
Yeah, absolutely. I mean, we are focused solidly on the NASDAQ right now, down more than 2% in the futures trade. And we've had a pretty incredible rally, in fact, on the S&P 500. On Friday, we started out the day at around 5,300, and yesterday we closed at almost, 4,300. Yesterday we closed almost 4,600. So it's been a good run, but the tech stocks drop could pull us down substantially today. The 10-year yield is coming down 176.99 as investors look to bonds for safety. Also looking at the dollar, it seems, for safety right now. The Bloomberg U.S. dollar index at 1179, almost 1180. And Bitcoin is down 1.5% from the trade at midnight and down substantially from the $38,000 and change that we saw at this time yesterday. So right now trading at 36,394. It has moved down in the last hour, and that is obviously, as we know, a negative risk indicator. Kaylee, what do you see in terms of the big pre-market movers today?
They are big indeed, Matt. One stock responsible for about half those losses for us, NASDAQ 100 futures you were talking about, and that is Meta Platforms, down 20%. Remember, this is a $900 billion company, so this is going to be a massive market value downdraft here. About $180 billion could be wiped from that company's valuation come the opening bell. Of course, you have Facebook user growth stalling out. Apple is creating headwinds, potentially $10 billion due to those software changes, and competition from TikTok is really just affecting the company. That has a negative read-through to other social media stocks as well, including Twitter, which is being dragged lower by about 7% before the bell today. You also had Spotify reporting last night, user and subscriber estimates for the first quarter coming in well short of what Wall Street had expected, and as a result, that stock is down nearly 9 percentage points. And of course, Anna, it all sets the tone for the last tech titan to report after the bell today. That would be Amazon. The focus here, how much have sales growth slowed down as the pandemic era has started to wane just a touch? Margin pressures, including from labor and higher shipping costs, and of course, we'll be paying attention to the cloud. Ahead of all of that, Amazon is down about 3% before the bell.
Yeah, it seems Alphabet, Google, that made us feel better. Then Facebook, Meta, that made us feel terrible. And now we wait to see what Amazon can add to the picture. In terms of feeling terrible, how terrible should we feel about the technology story here in Europe when we don't have many of those social media names to talk about, certainly not in big listed markets. But we are seeing some of that read across into the European space. So we're down by 0.7% on the Stoxx 600. And there is no escaping that technology downdraft. The sector in Europe down by 1.9%. As I said earlier, even a company like Infineon, which is a chip company so different from something like Facebook and Meta, but that company to the downside, despite the fact they were guiding higher in their earnings release this morning. This is something that Europe is seeing some cushioning from, and that is higher energy prices broadly speaking, through the start of the year at least, and Shell up by 1.4% in today's trading session. A big buyback being announced by this business, that reassuring to investors who are so focused, if you're involved in that sector, so focused on returns of cash. Roche Holdings in the pharmaceutical space down by 2.9%. Some conservative outlook statements coming through from the business, but a lot of focus on just how much they can really predict the year ahead. They've made so much money out of diagnostics around testing for COVID-19. The path of the pandemic from here, Matt, is going to be crucial for a company like Roche.
Yeah, absolutely. And then don't forget, we've got the car makers coming out as well. Or actually, I should rephrase that. We had General Motors with a beat, by the way, and a positive outlook. It still fell yesterday and is down 1% year to date. Tonight we get Ford, so it'll be interesting to see how the chip crisis has affected them. They're unchanged year to date, and that could turn the picture around for the industrials. Hannah Gooch-Peters, global equity investment analyst at Sanlam Investments, joins us now to talk about what we, I guess, should expect. Volatility seems not to be going away, Hannah. Even though the VIX has come down substantially, these tech stocks show us we can still really see some swings in the markets.
So we've seen some real volatility, particularly in the NASDAQ over the last couple of months. I think what has really happened is that particularly in the US, investors have become very, very focused on valuation. This is something we were warning of toward the end of last year, and I think in November it really hit a tipping point, and those chickens have almost come home to roost, if you like. There really is no margin of error for companies that are trading on very, very high price earnings multiples, very low free cash flow yields in terms of their earnings releases, any kind of bad news. They're now selling off very rapidly, and the market is taking a very dim view of any bad news for companies like that, particularly in the tech sector.
Yeah, Hannah, sticking with the tech sector, good morning. I put this to one of our colleagues earlier, that this reminded me of some 10 years ago when Facebook was a little slow to grasp the need to move from desktops to mobile, as amazing as that sounds now. But they did, they got there, they were just slow to start. And I wondered whether that had any parallels with the TikTok story. And then I just wonder, from a broader technology perspective, how much read across should this have? What we're talking about here, is it very specific to Meta and to Facebook? I mean, the numbers out of Google seemed better, seemed reassuring, and we wait for Amazon.
So I think in terms of the market and sort of say perceptions of slowing growth, I think that companies like Amazon, for example, and also Facebook had announced this sort of 10 billion of cash being invested into the metaverse. The market is now being very cautious on news like that when we're making these big investments. And any sort of slowdown, so Facebook had their slowdown in their user numbers in Q4. The market is now penalizing that. We saw things, a very similar situation with Netflix. We've seen large pullbacks in companies like PayPal. So I really think that, Facebook went to a point where it was on 25 times forward earnings. And it was, in the context of this historically, it was just starting to look a little expensive. And I think that when valuations move up and you have these, it might not even be that much of a big deal in the terms of a longer term outlook of a company. But I think the market is just being very punitive at the minute on companies like this.
Okay, so when you're expensive, you really have to deliver.
Yes.
What about the pivots into value then? This is something that's benefited the FTSE 100 since the start of the year. It's up by 2.5% when other markets have been into correction territory, for example, the NASDAQ. Is that a place that you're looking to for future gains, or do you think we get over this tech tantrum and we're back to seeking out growth?
So I think that the whole growth versus value dispersion actually happened a lot further back than investors realize. People are looking to the start of this year saying, well, value is up 0.6, growth is down 7. But actually, I think if you look back, the real turning point for that was back on the pandemic day, 6th of November 2020. And if you look back to that point in time, we've actually got value outperforming growth by over 20%. And so I think this year for us, it's not so much about whether you're in the growth value bucket, whether in your value bucket. I think it's about careful stock selection. I'm actually really excited for this year because for active managers, I think it's a real point in time where you can actually be not different for the sake of being different, but this volatility that we're seeing in the market right now is really cause for opportunity for good stock selection.
Okay. And how do you factor that in regionally, Hannah? Thinking about a value rotation, where do you want to be?
Did you hear that, Hannah? Sorry, the question.
So sorry, I don't have anything in my ear.
Oh, I apologise about that. So Caleb is asking about where do you want to be in the value rotation? If you believe that value, I know you've got some doubts perhaps about it, but if you want to be in value, whereabouts in value do you want to be?
I think we have to be really careful about balance sheet strength. So a lot of the sort of value factor, if you like, is littered with companies that have perhaps very sort of low operating margins, no earnings, and are very indebted. So I think that, and particularly during the pandemic, we saw these big drawdowns. Companies that did not have that balance sheet strength and profitability were really suffered at points in time. So I think that whilst we must be mindful of valuations, we also have to be mindful of the quality of the business, in particular having, if we can, net cash on the balance sheet is very important.
Hannah, really good to speak to you. Thanks so much for coming in. Nice to see you here in the studio. Hannah Gooch-Peters, Global Equity Investment Analyst at Sanlam Investments. And don't miss Bloomberg's monthly series, Chief Future Officer. The latest episode features the Mondelez CFO, Luca Zaramella. You can also check out our interview with the Macy's CFO, Adrian Mitchell, both available on Bloomberg.com and on YouTube. Coming up, we'll be back to the central bank stories, 2 in focus today, a tale of 2 cities. Bank of England and ECB in focus. Chris Hare, HSBC senior economist, joins us. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think there's a tendency in the bank just to see rises in inflation as a temporary phase. And there's obviously a lot more going on in the economy than just some of the temporary factors like higher energy prices or global supply chain shortages. But the bank has been very slow to recognise that.
That was Andrew Sentence, former Bank of England MPC member, calling for a robust review of the committee's performance in an op-ed for the Times of London newspaper. Andrew Sentence criticises the central bank for getting forecasts badly wrong. Let's get more on the Bank of England and the ECB, both making their decisions today, of course. Chris Hare, senior economist at HSBC, joins us here in London. Chris, let me ask you what you expect then today, but also longer term in terms of rate hikes from the Bank of England, because is there a danger that with the cost of living rising in the second half of the year, depending what the Treasury decides to do about that, that the Bank of England is held back from its intention to take on inflation in the second half?
Yeah. Well, I think the prospect of a 25 basis point rate rise is pretty much baked in for today. We expect the committee to vote unanimously for that. I think what's really interesting, though, is over the medium term, the extent to which any series of rate rises will stall later on as we look forward further into this year. Now, market pricing under the Bank of England's forecast has bank rate going up to 1.25%. I think broadly speaking, the MPC might say they're kind of happy with that. Our forecast is for bank rate to go to 1% because ultimately, you know, we do think, of course, we know that inflation's high at the moment, but we think there's still something to be said for those transitory factors. We don't think energy prices are going to keep shooting up. Supply chain disruption should dissipate eventually, and we've got that real income squeeze going on at the same time, so that should inflation come back down, should we also see some of those headwinds to the demand side of the economy, maybe that narrative of continued ever-increasing bank rate will lessen somewhat, so we think that the bank could eventually pause later.
And we'll see what the Chancellor has to say about the cost of living as he speaks later on today. Matt?
Yeah, I wonder about the strength of the pound, Chris. If you step back and look at it, obviously historically, it's been an incredibly sound currency, and it's still a financial capital of the City of London. On the other hand, you're post-Brexit, and they're very concerned about a garden party. So do you see euro-pound falling as these two central banks diverge, or what's your view on sterling?
Well, we've got sterling broadly steady in our outlook because when you think about potential divergences in policy rate, you know, we think the bank rate will rise a little over the next few quarters, but by a little bit less than market expectations. And when we think about the outlook for the ECB, you know, we think that the deposit rate will eventually rise next year, but will rise by a little bit less than market expectations. So that we're a little bit more dovish than the market on both, but it all sort of balances out that we think euro sterling will be broadly steady. When we think about other political type issues, well, those haven't really affected the currency in a major way over the last few weeks and months, and we don't necessarily expect that going forward.
What about growth, UK versus EU? I mean, is it still a freer market economy that's subject to faster growth?
Well, one would hope and perhaps expect that, you know, if you observe over the last 15 years or so, that long-run productivity growth in the UK has been somewhat firmer than in the Eurozone. Potentially that UK outperformance might lessen somewhat, because if we think about it in the Eurozone, for example, we think there are potential upside risks to the potential growth outlook when we think about rising levels of public and private sector investment that we're seeing in part driven by the EU Recovery Fund, for example. In the UK, you know, we think that, you know, relatively sluggish financial crisis, productivity growth can continue, but we don't necessarily see too many upsides to that. So yes, if the UK could continue to outperform in the long run, it's still possible, but maybe to a lesser extent than we saw in the decade following the financial crisis.
Okay, Chris, so you talk about upside risks to EU growth. There clearly has been some underappreciated upside risks to EU inflation. Factoring both of those in, what message does Christine Lagarde have to send today?
Yeah, well, the inflation upside that we saw yesterday was pretty staggering. You don't see upside surprises to consensus of, what was it, 0.7 percentage points very often. And you would think that some kind of a narrative shift may have to come from the ECB, at least to some extent. I mean, already we're seeing potentially some more hawkish governing council members pushing for the ECB to more strongly acknowledge upside risk to the inflation outlook. I think Christine Lagarde probably will acknowledge those upside risks to a firmer extent than before. But will it lead to firmer policy action? I mean, what we know is that in December, the ECB already essentially sort of locked in a series of continued asset purchases through the course of this year, albeit to a decreasing degree, and that rate rises won't come until after that. Is the ECB going to change that stance? Perhaps it's not quite there yet. I think Team Transitory is still a strong voice on the Governing Council, but, you know, I think maybe there are some risks to that policy outlook.
Team Transitory lives to fight another day. The T word is still alive and well in 2022, in a European context, perhaps. Let me ask you then about what's happening in bond markets. To Kaylee's point about the shifting expectation around the ECB, we've seen certainly the short end of the curve in Europe, thinking about German bonds in particular, has been adjusting upwards, yields adjusting upwards, higher expectations that we get those rate hikes sooner. Do you think the ECB will want to blame our friends across the Atlantic for that and say this is too much to do with what's going on in the US and doesn't really reflect the European story?
Yes, to an extent, although I think given the upside surprises that we and indeed the ECB are seeing to inflation, I think it should perhaps only cautiously push back against where market pricing has got to, because there are those upside risks to inflation that in turn pose upside risks to policy rates and to bond yields. Having said that, you know, with markets pricing in almost 30 basis points worth of deposit rate rises by the end of this year, the ECB is not there yet. So it might push back at least gently to that extent, but, you know, only with a degree of caution given those upside risks to inflation.
Chris, great to see you. Busy day for Chris Hare, Senior Economist at HSBC. Thank you very much for joining us. And stay with Bloomberg for our coverage of the rate decisions and news conferences from the Bank of England and from the ECB. It all starts at 7 a.m. in New York, 12 p.m. in London. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. And also joining us now, Tom Keene, co-anchor of Bloomberg Surveillance. Tom, I really expected today to be all about the central banks, the BOE and the ECB, and instead it's about tech, the Meta of yesterday and the Amazon of later.
It's about both. It's going to be a really, really interesting day. Of course, Bank of England and ECB out, and there's some real interest there. And of course, the Fed testimony in Washington will be sport as well. But yes, the back and forth, the good, the bad of earnings has been extraordinary, and that, of course, culminates with Amazon tonight. Let's look at the underperformance of Amazon over the last year. They're investing massively, and this is from the beginning of the pandemic with a lot of good performers. Apple outperforming, Google in yellow with a real comeback. Even Microsoft pulls up, and Amazon, just at the S&P 500 index level, has been an underperformer. A lot of people here are looking for pandemic normalization, including Joe Feldman at Telsey Advisory Group. He writes a nice summary today with a really, really enthusiastic buy on what they're doing at Amazon.
All right, so how much does this matter in terms of the volatility? Because the VIX, I think, is down at 23 or 24, and yet we're getting these wild swings in mega cap tech.
A lot of people, Matt, are saying this year it's not all boats rising. It's a story about individual securities and individual performance. To me, the earnings story of the week, and frankly, it's a tech performance, was UPS. I think UPS's performance this week was frankly more important than Google. It shows companies that execute are being rewarded in the market, and those that fail don't. And, you know, Matt, I looked at my TikTok. I mean, I'm spending more time, Matt, on TikTok than I am on Facebook. That's all there is to it.
I don't believe it. I don't believe it. You don't really, do you?
Well, it depends. I've got my TikTok coach, Samantha, in makeup, and she's got me going here. I'm watching Rihanna do foundations, and, you know, there's a lot of good lessons on here.
I would just love to see you do a TikTok dance, Tom Keene. I hope one day that is coming.
Oh, is that what they're doing on here? Those are called TikTok dances?
Yeah.
I did not know that.
So you don't actually use TikTok that much.
Oh,
Tom Keene, co-anchor of Bloomberg
to
Surveillance. Keep on scrolling. Thank you so much for joining us. Now a quick look at what else we're watching today. I am watching what we were just talking about, Amazon earnings. Focus on margins with labor costs, shipping costs, how much has sales growth slowed down, what's going on with the cloud. But separately, I am also watching Jeff Bezos, the founder of Amazon's super yacht, Matt. They have to dismantle an entire bridge just to get it to him. Also, this thing needs a support yacht for his helicopter. I mean, that is next level money.
You got to do what you got to do. You know, sometimes you got to take down a bridge when you need to get your sailing yacht.
I guess.
Through the lock. I'm watching Ford, the big blue oval today, coming out with earnings. And interesting on a couple of levels. We're expecting to see 45 cents of non-GAAP diluted EPS, $35 billion of revenue. I'll just mention my favorite, my new favorite function on the Bloomberg, MODL model. MODL is a great way to watch earnings and financials. Ford has done incredibly well, the stock, over the last year. I put it on a chart comparing it to General Motors, Stellantis, Tesla, Daimler, BMW. It is outperforming everybody over the last year. Thank you to Dan Curtis, my producer in London, for making the Ford line blue. That is very fitting. It's just incredible, the climb, and it's now worth more than General Motors.
It is incredible. Helps you read it quickly, doesn't it, when they are all, quote, unquote, the right color. I love the Jeff Bezos story. I'm glad you're watching that one, Kaylee. I think it's just amazing timing, the battle of the billionaires, when you see one billionaire looks set. He could lose $24 billion. This is Mark Zuckerberg, if those after-hours losses were maintained through the day, of course. And another billionaire is having a bridge dismantled so he can get his super yacht out. Great juxtaposition there. I'm watching the UK energy story. We have here, in just a few minutes' time, in fact, the regulator in the UK is going to set a new price cap on energy, and this is set to be a big jump, an increase of 50% on the average energy bill. To what extent will the Chancellor then, half an hour later, mitigate that higher spending cost? This has an impact on the Bank of England perhaps as well. More surveillance is ahead. We'll hear from the Merck CEO, and Danny Blanchflower, formerly of the Bank of England, joins the team as well. This is Bloomberg.
This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Came into the year pretty optimistic about the economy, about earnings, and that's still our view for February through December.
I think we'll look back on 2022 and say this was Europe's year.
In the second half of the year, the focus really will be on the ECB. How far can the ECB go?
I know it's a very popular narrative out there that the ECB has to act sooner and faster, just given some of the spot inflation numbers.
I think what all Christine Lagarde can do is to slow down the process.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Facebook getting absolutely hammered from New York City. For our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your NASDAQ down 2%. Tom Keene, Facebook undoing what Alphabet did.
I don't think it's a surprise. I think there's been a lot of very carefully considered holds and sells on Facebook. A few of them, the sell side caught unawares here. But, I'm sorry, John. And, in my work on Facebook 2, 3, 4 years ago, they're just not as visible as they used to be. And I really take seriously what Mr. Zuckerberg said about Facebook is losing share to TikTok. It's a serious issue. Once again, John, the arrogance of Silicon Valley doesn't doesn't signal the challenges they have.
Well, TK, how can you say it's not a surprise when a stock's down 20%?
That's exactly what I was
think
going to
it's
say.
not a surprise because these are executives with a different rule book than other executives. If the senior officers of John Deere did this, they'd have their head handed to them.
We've seen it on Netflix, Elisa.
Yep, exactly.
We're seeing it on Facebook this morning.
It's a huge surprise to markets. I mean, just to put this into scale, the idea of a nearly 24% plunge after market yesterday in Facebook equals about $200 billion in market cap. That's basically Netflix getting eradicated from the NASDAQ, to give you a sense of how significant of a decline this is. It did come as a surprise because we saw from Google, they actually got incredible advertising revenue. So why was that not able to give momentum, at least to Facebook, at a time when their users are not growing?
Because the 51 buys on a stock aren't dialed into Facebook and what's happening with TikTok quite like Tom Keane is. TK, talk to me about it. Why did this not surprise you? I'm going through the calls here. 51 buys, 9 holds, 2 sells. 2 sells on a stock.
I take the point. It was a surprise to the sell side because these executives feel like they play with a different rule book than more traditional, what I'll call American corporate officers. There's an arrogance here. They should have communicated these challenges way out front. They didn't.
So you and I are both on the same page here because I made the same complaint about Netflix, Tom. When you see companies this big have market moves as large as the ones that Lisa just talked about, it's a problem. But Tom, is it just corporate communication or does it tell you something about the market we're in today? To see moves like this, 20% Netflix, 20% Facebook.
Gina Martin Adams has been very good about this and many other guests. I believe we've got Mike Wilson lined up today. And John, what this is about is individual stock selection, which seems to be front and center this year. And that goes to Amazon this afternoon.
Well, it makes up 5% of the NASDAQ 100 and NASDAQ 100 futures are down half.
John,
we are lower by more than 2%.
You know,
Pause, TK. This is the bit where I go through the market action. Lisa comes in to do a morning brief and we get to the guests.
Okay, I'm on TikTok. You know,
You carry on. Keep scrolling.
I'm on TikTok.
Can the camera make that nice, beautiful move just around the corner? Just whip it round. Futures negative 2.3%. There it is. On the NASDAQ 100. On the S&P 500, down by more than 1%. We're going to have a busy one today, Lisa. Your 10-year yield, 176.99. Lisa going into 2 big central bank decisions this morning.
I mean, honestly, today is such a pivotal day in both central bank policy as well as, frankly, tech earnings after the bell. Let's get started with Bank of England. They're going to come out with their rate decision at 7 a.m. Eastern time, followed by the ECB rate decision at 7:45 a.m. Eastern time, followed, of course, by press conferences by the respective presidents versus the governor. How much are we going to see a surprise here? We're expecting the Bank of England to hike rates to 0.5%. It's increasingly baked in. The ECB, frankly, is more interesting to me. Can they signal that they are really going to remain on hold given a 5.1% inflation rate? If you take a look at real yields, they've actually ticked up to really low still, but you know, they're actually indicated up as people can contemplate an ECB that possibly moves away from some of their very loose policies. 8:45 a.m. This will also be interesting. Senate Banking Committee is holding a confirmation hearing for the Fed governor nominees Sarah Bloom Raskin, Philip Jefferson, and Lisa Cook. Very much front and center will be inflation. How much do they really talk up the strong labor market? And how much do they look at wages, which have been increasing pretty significantly? We'll get the latest read tomorrow when we get that monthly jobs report. But honestly, how much can they look at this and say real wages still are lagging behind? And how much is this going to be a problem for them? And aftermarket, Amazon.com and Snap are both reporting earnings. Amazon, the focus is going to be on the wage front. Basically, how much are they going to have to pay people to come in and stock their warehouses and make it all happen? Snap, however, is possibly more interesting following Facebook. Shares down nearly 16%. How much was Facebook idiosyncratic? And I do keep calling it Facebook rather than Meta. And how much does this really represent a sea change in the entire social media space? It's going to be hard to escape.
Can you imagine buying Amazon right now, Lisa? How nervous you'd be going into the print, seeing what happened with Netflix, seeing what happened with Facebook over the last couple of weeks?
There's been a lot more bad news baked into Amazon. If you take a look at the performance last year, the performance year to date, people have already factored in smaller margins. They've already factored in a lot of aspects at a time when Amazon's much more diversified. Facebook derives 98% of its revenue from advertising, whereas Amazon has AWS, which is still going strong. So these are some of the issues that people have to parse through ahead of these earnings.
Really solid point. Last year, that stock did virtually nothing compared to the benchmark index here in the United States. Mandeep Singh joins us now, Senior Technology Analyst for Bloomberg Intelligence. Mandeep, I'll start with a short one. What went wrong?
Well, so clearly they said they're going to create a new segment structure and give us the numbers around Reality Labs And now we know they're losing $10 billion on Reality Labs, the metaverse play. Other thing is, yes, there's a deceleration in social media advertising. It's not as surprising because search did really well. So when you look at the overall digital ad market, it grows around mid to high teens. So if Google is growing at 35%, it's coming at the expense of somebody. Looks like it's coming at the expense of social media ad spending overall. And that is why you saw, a muted guidance from Facebook. But what was really surprising was they said they're doubling down on videos. Now that really changes the whole margin equation when it comes to Facebook, because now they have to pay the creators. And when you are paying to the creators, the model is very similar to YouTube. So your gross margins goes much lower than the 80% they currently make. And that, I think, is what spooked the market.
Mandeep, there's also a broader concern here that we've brought forward a whole lot of growth in social media companies that will be obsolete by next year or in 2 years. How much is Facebook a harbinger of what could come with Snap, with Pinterest, which we're also seeing tumbling today?
Yeah, so they all fall in that social media bucket. I do think, with Facebook, the fact that they still have 3 billion users, yes, the engagement is dropping, but at the same time, they're still the scale player. So as a small business, you don't have a lot of avenues to advertise. Either you buy the keywords from Google or you advertise on YouTube, TikTok, or Facebook. And Facebook, remember, the reach is the broadest when you think of all the social media players. I think Pinterest and Snap may be in bigger trouble in terms of the engagement levels from the print we saw with Facebook last night.
Mandeep, unbelievable stuff. Thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Lisa, that move down by more than 21% earlier today. Now down by, what are we now? Negative 20.5% in the pre-market. Just unreal.
It's amazing to think how much of the user participation we've really brought forward at a time when is anyone using Facebook? I mean, to Tom's point, if you take a look at the clientele, it's skewed to the aged, I should say.
I mean, okay, you want to go there? I don't want to go there. Tom clearly does not want to go there. He's gone very quiet. Let's bring in Katrina Dudley, portfolio manager and research analyst at Franklin Mutual Series. Katrina, some of these single tech names, can you walk me through your understanding of what's happened here? Not just to the downside, Alphabet 2 to the upside. These are monster names, seeing some massive moves. What's your takeaway?
I think what you're seeing is a correction in the market that's somewhat a recognition that the business model is flawed at Facebook. And so people are questioning that. But you're seeing a very significant move, as you said, in some very large cap names. If you focus to where I'm a little, my kind of wheelhouse is in the industrial space, for example, where we're also seeing some new concerns there. We're seeing revenues come in really strongly, but they're coming in with margin pressure. And that's a reflection of some of the things we've been talking about. Inflation in the wage costs. We're talking about inflation in materials, inflation in logistics, and that's pressuring margins. And that's something that's going to be the concern of 2022.
Katrina, let's combine in here the Facebook, Netflix battles, and who knows what we'll see from Amazon. I don't want you to comment on individual securities. I know that's inappropriate. But I do want you to talk about individual stock selection versus sector bet. Which matters this year?
This year's stock picking is going to matter. I think that I've said previously, I think that this is a value market and we're going to really see a return to value. If you look at a growth stock, when you get a growth stock wrong, you get the year wrong. So you get the year when they hit those revenue numbers wrong. And instead of, say, 2027, they hit them in 2029. And you can grow in with time. And stock picking really doesn't matter when you're looking at that kind of top line growth scenario. In value markets, stock picking matters because you're betting on execution and you're betting on teams doing the right things, being able to protect markets. So I think that 2022 will be a value market, which makes it a stock picking market.
If the mix shift of nominal GDP, of real GDP plus inflation is changing and we come down from a China-like boom economy, how do you study the revenue line of different value categories?
So first of all, I think you need to really get a good understanding of pricing power, because in an inflationary environment, that is the key tool in any company's toolkit that they can use to offset that inflation. And that's a company by company understanding. You need to take a look at a company's gross margins and see what do they reflect about the markets in which they operate. Are they kind of oligopolistic and they have that pricing power, or they're hugely commoditized when they don't have that? So I think you really need to understand companies. You can't just understand a sector. You could probably group certain sectors together. Obviously, oil companies, mining, which all trade together as a commoditized market. And you've seen great, top line growth there driven by pricing in those markets. But as you move further away from commodity markets, you really need to know what you're buying and what its positioning is.
Taking a step back, though, Katrina, at what point do we look back on this as a dot-com redux? Basically, the idea that these specific stock stories become a broader concern when you're seeing $200 billion of market cap wiped out in hours.
Yeah, well, we've seen a lot of these things corrected last year. So if you look at what happened in the NASDAQ last year, 40% or 4 out of 10 NASDAQ stocks were down 50% from their 52-week highs. And that was really in the profitless tech space. That's then it's migrated over to the SPAC area, where those kind of blank check companies are under a ton of pressure. And now we're finally seeing it move into the tech space. It's not going to hit all tech the same, though. Some of the tech it's going to hit because rising interest rates will reduce down those terminal values. Other parts, it's actually just pure competition. In certain situations, the competitive landscape has changed, and people have just not acknowledged that. And large stock declines are a real reflection of the fact that people now believe that there's been a fundamental shift in a business model, and they're revaluating and taking stock again.
Revaluating in a massive way. Katrina, thank you for joining us today. Katrina Dudley of Franklin Mutual. Lisa, these are huge moves. I'm just going through the earnings surprises on Facebook and looking at the quarterly performance after the quarterly earnings, the day after. We haven't seen a move like this ever for Facebook since it's been a public company.
We haven't seen them actually not grow their base users also since they were a public company in 2012. And this comes as their base users, I think it was 2.91 billion each month. I mean, at a certain point, it's, well, we've reached saturation, but if they start going the other way, which there are indications that they are, it's a big problem. But what's the problem for an index level when you have such a behemoth moving like this?
We came close in 2018. There was a 19% move, a close to 19% move. But Tom, this is what happens if you're considered a growth name and you don't deliver growth.
You got to deliver.
You've got a bit of a problem.
John, I have a huge issue, and I've said this to Jim over at the Death Star. To conflate the FANG stocks all as one is wrong, wrong, wrong. They each have an individual character and individual story.
Futures negative this morning. Good morning to you all. Your central bank decisions coming right up.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein,
deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front row, the best seats in the house for business's greatest minds.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
In London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
I had a great opportunity to talk with Sarah Bloom Raskin in the last week, and I asked her specifically about how she sees this issue of the Fed and assessing the risks of climate change when it comes to our financial system. And I thought she was so sensible, so reasonable, as she said how we need to understand climate just like we understand other risks. We need to look.
Senator Tina Smith there, the Democrat from Minnesota, from New York City with Tom Keene and Lisa Bramwitz. I'm Jonathan Ferro. Going into some hearings today for the White House's Fed picks. Looking forward to that a little bit later this morning. Futures negative, a little more than 2%. This is a big move lower on the NASDAQ, down 2.3%. On the S&P 500, futures there softer by a little more than 1%. Of course, on the NASDAQ 100, Facebook making up about 5% of that index. Facebook down around about 20% through most of this morning. Into the bond market, yields 177.52. Euro dollar negative a quarter of 1% at 112.77. Bank of England decision coming up, Tom, in about 42 minutes time. Then an hour or so after that, we'll hear from the ECB and then into a news conference with President Lagarde.
We're going to dive into that. Manus Kearney, I believe, is in Frankfurt, which will be of great assistance. Just because of the speed of the show today, let's get right to it. Jack Fitzpatrick with us. He is in Washington. As the president will be in New York City. Jack Fitzpatrick, what is the goal of the handlers of the president on a presidential visit to Manhattan today?
Well, I think the political goal clearly is make it clear that the president and other Democrats, such as the mayor of New York, Eric Adams, support funding for the police. They're going very far away from anything you heard about defunding the police. The president is expected to talk about funds that went to state and local governments and how that affects police on the street. As for the handling, president sometimes speaks a little extemporaneously, try to avoid mistakes, I'm sure, is the goal there. But really the focus is sort of the opposite of a defund the police message from the president and presumably Adams as well.
What is the response of the liberals to that, and particularly the fury of, I believe it was 18 months ago?
They haven't had that much of a loud response on that. If you look at the legislation that they work on in Congress, it's a bit more pro-police from Democrats even than you might expect if you were paying close attention in June 2020. There's more grants for police in spending bills. They're bringing back earmarks, and you've got a bunch of Democrats with earmarks specifically for their local police departments. That is one issue where the progressives it's kind of fallen off the table for the progressives.
All right, it's falling off the table for the progressives in Washington, D.C. when it comes to the Fed picks in terms of the message. We've been hearing a message before these Senate hearings that take place today for this Fed governor nominees, and really all of the discourse has been around combating inflation. Can that remain the message at a time when President Biden also wants to cater to the more progressive wing?
Republicans are going to test the extent to which these nominees focus solely on inflation. The questions that we know are coming, especially from Senator Pat Toomey, the top Republican on the Banking Committee, are focused on Sarah Bloom Raskin and her the extent to which she focuses on some sort of regulatory role and climate change. That's a major concern for Republicans. There are going to be some questions about Lisa Cook's experience and whether it's entirely relevant to monetary policy. But there's going to be some sort of poking and prodding from Republicans to see how exactly are you focused on the core issues of inflation, or to what extent do you sort of shift towards somewhat of a regulatory role on behalf of the progressives that might like you to do so?
Jack, we've heard from the administration a number of different narratives around inflation, that it really represents a very strong economy, that it's a natural product of what we saw in terms of the stimulus and will eventually fade. What's sticking?
They are really pushing on the message that this is very much a product of supply chain malfunction, I guess, if for the lack of a better word. The fact that the pandemic is still an issue, the global aspect of this. I think it would be more convenient for the administration and for Democrats if they didn't have to say, yes, this was exactly a product of the fiscal response. They want to take credit for the unemployment rate dropping, but to say that they had to spend money pretty significantly, and you can't just pin it all on that. If they can make headway with the supply chain issues and see a reduction in inflation,